Okay. Good morning, everybody. Welcome to the Breakfast Club. We are Sunday edition of the Breakfast Club on the 17th of March. We're going to do a little pre-market analysis, and we're going to have a look at what we anticipate happening on the weekend. We're through Skype live right now. I've got Dave Barry on the line. Say hi, Dave. Or he's not
Hello, hello, everybody.
There he goes. So if you have any questions you want to pop in, just go into the Telegram channel there. You'll see the link. You can pop into the Breakfast Club here on Skype. And I don't think you need to even have Skype. You just click on that link and you can just get straight into the show. And if you have any live questions you want to chat about, then by all means, share the airwaves with everybody else. You don't want everybody talking over each other. But yeah, pop in, say hi. And if you got something to say, then or questions to ask, by all means ask them, and we will try and get to them. Dave and I will try and sort this out. I'm sure with two heads together we could solve any problems you all got out there.
Yeah.
Just double check, make sure we're live on YouTube as well, so if anybody's interested in popping in, they can dismiss. This is my typical ritual in the morning. Okay, there we are. Simo show. Hey, Simo's here. All right. So, NASDAQ. We still got this upper. Still looking for this. I'm expecting this just to go parabolic as AI continues to grow and new AI comes out. And then when this new chip comes out with NVIDIA, when that new chip comes out with the Neuralink or Neuro processor, you're going to really see, and it's going to be really small. AI will get into so many different household appliances. The tech will literally blow the industry. We're about to see a revolution in the NASDAQ, in the tech industry. This 1900 is, or 19,000. Keep your eyes on this. This is going to be nothing. In the future, we're going to be rocketing up because of AI and all these other charts. Like as Michael says, high tides, all boats rise in high tides. So as we see this continuous push up in tech, I think we're going to see these other industries starting to respond as well. But we're still anticipating this big drop back in April. If you look at the seasonal tendencies for the NASDAQ, this may be the last time that you start to see seasonal tendencies responding as they normally do. Because of AI, my belief is that because of AI, we're going to see the seasonal tendencies change quite a lot. You're not going to see the typical highs and lows that you normally see throughout a seasonal tendency chart for NASDAQ, because we have a revolution that is occurring in the tech industry. And I think that's going to adjust over the next few years, a new seasonal tendency. So that's my guess. Uneducated as it is, that's just my thoughts. Don't put any bets on that, but that's my thoughts anyway. What do you think about that, David? He's going to be all quiet now, sitting in the corner.
Oh, sorry, I was muted. Yeah, I mean, when it comes to AI stuff, I mean, I understand it all, but being new to year and a half into trading, how different things like that actually affect the market versus how the interaction between the algorithm and how Michael teaches it. I'm still trying to correlate the two together. What's moving price, and then how the algorithm reacts to the different markets.
I tell you, he's given away some amazing secrets here. And if people really take the time to study his philosophy and his approach to the markets, they are going to see huge clarity, crystal clear clarity on how the markets are moving. And they're going to slowly start giving up on those ideas of, a bunch of analysis are going to predict where the markets are going to go. A bunch of companies are going to predict where they're going to go, and I think they might have an influence, minimal amount, but I think the algorithm is really what drives these things. So if you've got really good solid companies and they start to rise, you're going to see highs and lows forming in those companies that are perfect opportunities to get long. If the company continues to grow, you'll see many opportunities where prices offered in a discount range that you can get on that to continue on the trend up. So anyway, let's look at the NASDAQ here. We got anybody else in our little group this morning? No, it's just you and me, David. Oh, okay.
It's us. Two people online.
That's right. There's a couple of people. Hey, from Hungary. Christian. Simo beat you through the door this morning, Christian. Good morning. Well, we've got 9 people sitting there watching. That's good. Again, those of you who just popped in, you can join us on the Skype channel. I have a link in the Telegram channel. If you're in Telegram, you can just click on that link and join us here if you have any questions you want to verbalize. If not, you can just write them in the chat box on the side there in YouTube, and we'll try and get to them. Okay, so let's get to the June contracts here. So I'm liking this. If we're looking at this range here, let's make this a little bigger. We'll start off with each one of these because we've got a lot of time for this. So if we look from low to high, and we look for premium array, there's another small one here, and a discount array. Inside that range, we also have this breaker here, last down close candle before run above these old highs, and we now have a breaker that runs below. I guess it's like a parent breaker of this run below these lows here. We finally took it out. You could say it would be this one here because we have a swing point. So if this one provides a level of support, we're really between here and here right now. This up close candle, at least this down close breaker. And we're in the middle of the range. So if you see 50%, we're just dipping down into the 62% retracement. So if we end up getting a fill of this fair value gap, because now we've run these lows, if we get a fill or back to this breaker here and get a reaction off, where are we looking to get back into? Premium array, back into this breaker here. So breaker to breaker trading. So look for these old lows back here. This to come back into the range, back into the 50%. If we kick off of that and continue back down, we're looking for lower prices. Now, the seasonal tendency for March, it tends to make a high in March. And then we have a big drop down into April. So April, I'm kind of looking for a run back into this trend line phantom here and get right back into this order block here, or at least dig back into this old high here before pushing back up for higher prices. So it's quite a sizable drop when you look at it overall. It's like 1,000 points just to get down to here from that high. But before we start running too many PD arrays away, which we're really in between here and here. So from a weekly basis, let's look at the weekly candles here. The weekly, we have this imbalance down in here. So we'll see where these things line up for confluences that support the idea we just had there. Weekly. I don't have a weekly price imbalance. I have a weekly, we'll call it fair value gap, I guess. So your weekly candles, although we came down to 62% of that range. We have this little imbalance here. So if we push through here, back into this imbalance, I want to see this provide one of those little touch points for a run back up into higher prices. So I want to see a continuation down this week. Give us a Tuesday, Wednesday low, a rebound back into a breaker, midpoint of this daily fair value gap, that consequent encroachment, and then a rollover back. So I'm going to pull out the tool Derek showed me about. I'm excited about this tool. I love these tools. I've got to find it first. Is this it? Here it is. The pathway. So we could see a pop-up and then a run down. Oh, sorry. Let me stand by here a second. I have to print something for my wife. Okay. Print. It's printing right now. So sorry, a bit noisy here. My printer's going off. So we're looking for a, let me just adjust this here. So we're looking for a potential, we're looking for a reason for it to go back up into a premium, to go back into a discount on the weekly, unless we just open up right here and just continue back down. But because we're just slightly below this order block here on the weekly, we come back up into the edge of that 50% of that wick, or even a run back up into this high again, which I really wouldn't want to see. Just come back to this mean threshold would be nice, and then a continuation down into here. Nothing's really given me a lot of support other than the fact that we've just validated this weekly order block here, so we could come back from here to here, and then obviously you don't want to get all the way back into the mean threshold, which is the mean threshold of the daily above you here. You don't want to see that. But right now that order block's valid, so we've got 3 different points that we can look for entry. And the downside draw on liquidity is that little imbalance we see on the weekly. Now if we drop down into the daily and have a look to say what else have we got in here that supports that kind of run. So we've got a little tiny imbalance sitting right here. If I open this up a little wider, you'll see we have a little imbalance sitting right in here. We have a little imbalance sitting right up in here. So we also have a breaker, last stop close counter before run below these lows. And you can almost think these 2 candles here are actually, this guy's inside these, but I like this idea right here. We have a return to low, the open, and then the mean threshold of that breaker, which is also right around that little imbalance you see up in here. We're in this kind of a consolidation going on here. We've just run out the lows, so to run back up into a premium array, if we pull our fib tool from high to low on the daily, look where 50% puts us. Right near the mean threshold of this candle, inside this imbalance, and it puts us back up from a discount into a premium, and then roll over and come back down into running at lower prices if we're expecting that a run back into April now for running for lows. So you got to look for little confluences that support that idea. So what would we need to do? We need to be back up above this and into that range between these 2 fair value gaps again. If you're looking at that range, that's the premium, that's the discount area, breaker. So if you're trading breaker to breaker or premium to discount in terms of your fair value gaps that are in the bigger range, then I'd be looking for a return back into here this week perhaps. Otherwise we're going to be stuck inside this fair value gap here. We're reclaiming more and more of it to either fill it all, get on the other side of it, get through this weekly, and continue on the downside. This would be like the linchpin for me. If we can get below the weekly, come back into it, find some support at it, then I'm looking for more downside. So that would be the key player for me, and because it's so close to the daily fair value gap, that if we get on the other side of it, I'm looking for see how we respond off of that weekly. But we'd have a nice little run back up into a premium level before running those lows out one more time. So kind of waffling between the two. I'm in the middle of this, so I'd like to see a return, at least a small candle here forming on Monday. Tuesday come back up inside, hit this breaker, or ideally you'd like to see that be left open, But if we get a run back in here on Tuesday, and then a further continuation on the downside for Tuesday, Wednesday, and then Thursday, whether or not we get through this and aim into our rejection block. But look at that breaker. That breaker is going to be one of our key levels here for the downside if we start breaking through it. This fair value gap and that inversion, or that weekly inversion. So let's go down to a 4-hour and see what we can see in here. So we have a run above the highs. We have those taken out. We have a reprice rebalance right in here. See that? You can ignore that wick and treat that like it's an open fair value gap. And we run down, come back up right inside it, right here. See how the wicks are respecting that? Trade back down. Another reprice rebalance. You break through it, come back up inside it right here. Continuation on the downside. Hang on a second. And then we have a order block breaker, run below an old low. You come back up inside the bodies, respecting the bodies. Come back up one more time inside that, our little breakaway here, and we run for the sell side liquidity, all sitting down in here. So now that we've run that out with a nice wick, we've got some bodies down below it. We have this fair value gap here and here, and then we have that weekly inversion just below us. Obviously the daily fair value gap needs to be filled as well. So if this becomes a swing, look for a run back into what have we got left except this. See you later, love. Is this breaker right here. So that'll be a return back up into this breaker order block. So I want to see that come back up in here on a 4-hour chart and see how that breaker holds price. If we start to eat through it, then we've got our higher objectives on the daily we may be aiming for. A lot of these equal lows, looking for those to provide a level of support. We also have a breaker right here. This would be the breaker because it's inside this larger one with a body that actually sits below it. So this right here would be your run. You block this out all the way out to the edge. Let's take this here. See you later. This would be a 4-hour breaker here, I guess. Oops. Why does it keep blocking that out? I'm just going to leave it there. It might be the colors overlapping, making things a little more. You get the idea. That's the breaker you're looking for. So we've come down below it here, come back inside it. Are we going to roll over and continue down, or come back up inside a little deeper? Reconnecting these old lows, and then looking for further downside prices, or looking for a return back up into this small range here, getting into that breaker one more time. Victor, switching to Telegram. Wow, did you know you came on? Didn't know you came in on Sundays. This is so awesome. Yeah, we're just doing a Sunday review where we think the market's going to go for the weekend, Thomas.
Looks like we have some news this week too.
We have some news release. Yeah, let's have a look at that.
Wednesday's FOMC. Thursday PMI.
Let's look at that Forex Factory. So Monday's all Australian, Canadian. Tuesday, Wednesday, FOMC, yeah. Fed funds. So Wednesday, so you look at all this, and the heaviest Wednesday Like Thursday's not such a bad deal. You got the PMI, 10:30. Otherwise, the heaviest heaviest news releases on Wednesday in the afternoons. So we could get some consolidation until we get FOMC report. Then the afternoon session on Wednesday could be good. So if we're looking for a high or a low to form, Wednesday would be a great place for that. So looking for those opportunities for these inversions to happen, these points where you see if we take out a low and we get this fair value gap forming in here and we start to run above it and we enter into it on those levels with your stop loss sitting below, aiming for higher PD arrays or rejection block or old highs. Those inversions are just beautiful. They've been amazing on Bitcoin lately. They really have been. This weekend it's been kind of fun trading Bitcoin. Not that I would suggest people trade Bitcoin, but it's not a stock. It's just something for me to trade on the weekends. But I'll tell you, there's some interesting stuff I'll have to show you guys in a bit. So we'll keep Wednesday in mind for a high or a low to form. So what would that do for us again back on the daily? If we pull back into that range, like we sit inside here and waffle around and create a Wednesday low for a run back into the range, or a Wednesday high back in here for a drive down for the rest of the fair value gap, we're going to be looking for that swing setup Wednesday, Tuesday, Wednesday. Well, every day. You can check those. You can look for those things on every hour, every 15 minutes. You can see them. They set up quite a lot. As soon as a high or low is taken out, look for that swing setup and aim for the rejection block, order block that's in the discount portion of it. Just snipe some quick money out of that. Anybody got any questions so far? Nothing? Okay.
Hola, amigos.
Hola! Is that Victor?
Yeah, Victor.
Victor.
Yeah, I was actually working also on my charts, trying to identify the bias, since I'm also trading some stocks in between the Nasdaq. So trying to check if it's better to sell them just above break even or the profit they are now, if the market is coming down and coming in again later with a better price. So yeah, I was working on the chart. So glad I was on my desk when you guys started.
You got to see this, yeah.
Thank you.
That's awesome.
Thank you.
Yeah.
Once you're finished with the analysis, maybe I will have a couple of questions just in the general.
Yeah.
area.
Absolutely. Okay, so let's go to an hourly. There's that reprice rebalance right here. Run above an old high. We don't get a chance to get back into it. There might have been an opportunity to get into that somewhere in the 1 second chart or the 1 minute chart. I don't know. But there's your run. Look for a reversal pattern. Here's your reversal pattern right here. You see this? We have a fair value gap that goes down, takes out a low, and then up. And the moment it comes back into it, you get long. Now, in this case, you don't get to get in on it, but look, wait, and bam, right into it right there, and then off she goes. Okay? You can look at this one.
Right at the fair value gap, eh?
Yeah, right at that fair value gap. You see it just come back right into it, and then, because we don't take out this high. If you take out the high, you have to kind of wait for a reversal set up on the other side, like this one. Takes out the high, then we have a body trades below it, and then we come back into it. So we open actually below it right here, pop up, tap it, and run down for low, and run right back into our other layer. So when you have two, one that's overlapping coming down and one that overlaps coming up, just trade from one to the other and take out at the rejection blocks pull your fib tool, use your fib tool to scale out whatever methods you want to use to make your trades. But when you're looking at these kind of setups, you get in, put your stop loss up here, and as soon as it breaks down to you, you'll see them like every 15 minutes or every half hour, you see them suckers set up and you go, oh my goodness, they're just like bombers. That $100,000 account on that Leap thing, I've got it up to 80% already. So I'm only 20% away from doubling that in just over 2 weeks. Now I realize that doesn't mean to a lot of people, but I treat my demo accounts like they're real money. So yeah, you could put massive leverage and do it all in a day, but you're not really trading then, you're just gambling. I want to try and do it like a logical step-by-step approach. No different than this account here. It started off in November, and I want to kind of 6% it every month, just to kind of let people know you don't have to hit it hardball. You'll see me trade one handle or one contract, sometimes 3 or 4 contracts, but very seldom will I ever go for a 10 contract hit. I want to do it just a little bit by little bit, so you get the idea that you can actually raise these accounts. Just like Michael says, you can double them within a year. So that's how I want to treat these, so you get an idea that it can be done gradually. You don't have to rush at it. And then there's sometimes you can go hardball, like the Bitcoin account, and see if I can double that in a month. Okay, so that's the hourly. So we've got a lot of downside happening here. We've got a run on all this liquidity on the downside, and we've now hit the bottom, or coming to the bottom of that daily fair value gap. So I'd like to see this roll over here one more time, get in here, and we look for the setup like this happening down here. If it doesn't happen here, wait for it here. Don't think that they have to turn here, but these are the places you kind of put your eye to and start saying, I'm looking for this pattern to happen. The trade above, get back into it, and then you go long. Your stop loss goes down here and you go long, and you're waiting for what? Go to the next nearest range and say to yourself, what inside that range is a premium and a discount? Well, this is the discount array, so I'm expecting it to at least clear that. What's the 50%? Pull your fib tool, and every time it hits at the new fib level, scale out a piece of your trade. You don't always have to hit the perfect rejection block. And this one here, I love this because it tells you that people who are aiming for that high, you didn't get it, came all the way back down. Again, so you lost all that profit. You had to come all the way down and wait for the final run right there. Rejection blocks pay, my friends. Rejection blocks pay. Take your money at rejection block, because the difference between there and there is the difference between a winner and a loser, right? You lost because you were trying to squeeze every drop out of that lemon. And that's so minimal that it's not even worth it, and you've already banked huge bucks there. Anyway, so you get the idea. So we're looking for this setup occurring down here, or if you're looking for consolidation here, my cam model friends, consolidation, we run up, we come back down inside cam 1. Cam 2 is perfect right there. There's your cam 2. Cam 2 pops in one more time, your stop loss is sitting down here, and you run up and you start to aim for inside this range, premium arrays, or 50%. Pull your fib tool, run up to the next consolidation, which is here. You go consolidation to consolidation, discount consolidation to premium consolidation, and you go, okay, well, that's my target I'm aiming for. And look at that right there, boom, right on the money. And then it rolls over and comes back down again. Now, if you're aiming for the fill of that fair value gap, or you're filling, I'm going for the rejection block, I'm going for you're missing a ton of PD arrays in here. You're really pushing your setups here, because now that we've got a run down, we don't get a return back into that consolidation, right? So if you don't get a chance to have it hit on the way down and come back into it, if it doesn't, then expect it to get revisited later. And here it is. Now it can continue on the downside, offloading short positions or long positions up here to go short. Big money can weather this, gather up liquidity down here, offload positions, long positions for a short, and then drive it all the way through all this stuff. Looking for a reversal again. See this little right here at 2 o'clock in the afternoon? See that fair value gap there? We run above this high. We go wobble, wobble, wobble. We finally drop down here. We validate it the moment we drop below it here, and the moment we come back into it, stop loss will go up here. You run up, you almost tap it. You're like, oh, I was so close. And then you go, wait a second, boom, right there. Look at that, right inside that sucker. And then you pay yourself here, 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 here. Or rejection block, rejection block, whatever your strategy is. Now you pull that range and you say, what's in a discount array? Well, that sucker's sitting down in there, premium and discount. We've got lots of liquidity still sitting down here. Is there a high likelihood they can take a run on that now? Sure. As soon as that clears this low, your stop loss goes slam right up to break even, and you weather that now and watch to see where it goes. Because even if it turned back against you, you say, oh, that's all right. This sets up all the time. It sets up, that's the hourly. We haven't even got down to the 1 minute and all that other stuff. But I'll just stop on the 1 hours because you guys got the same concept happening. Well, no, let's go down to the 1 minute and see what goes on there. You'll see these things repeating themselves over and over and over again. You'll start getting excited about this setup model. Believe me, it's the only model, one of the only models I will trade on Bitcoin. Here's the swing low right here. Swing. You take out these lows down here. Look at that nice little liquidity run. There's the fair value gap. See it right there? Body trades above it. Whoop, next candle comes down, tags it perfectly. There's your drawdown, folks. Your stop loss is here. That's your drawdown. You're aiming for one here, equal highs. You're looking for higher breaker here. And you see it starts to eat through the breaker on that candle there. You see the body go through. You go, great. That's gonna take the highs out. Takes the highs, and the moment we get off that high, that breaker now becomes your next entry, because that's another model for a setup. When we get a bold candle that breaks up above a high, the breaker now becomes the level of support we're looking for. So if you take your tool here, look at it. That's your breaker. Run down below these lows. The moment we break above it with the body, you come back, tap it, you can get long there, and wait. Tap it again in mean threshold, just below the mean threshold. We're still inside it here, and then we have another little swing point, taking out a low. We go, we trade a gap above it here. You don't get a chance to get in on it there, and then we break another breaker right here. See that little guy right there? So if I take the same principle I just showed you, so I've just shown you basically two different setups here. That's the breaker right there, little tiny guy. So we trade above it. Did I get the top of it? I'll make sure I got the top of it there. We trade above it, come back to it, old highs, and then rinse and repeat. Same thing, pop up above. When you see that big impulse leg shooting above you, you go, ooh, yes, return to my breaker. Or those are my friends that like the CAM model. You've got a CAM 1 model right there. Inside this consolidation, they go CAM 1, and then off they go. Here's another CAM 1, CAM 2, CAM 3 model. So you have your consolidation with the leg that takes out the consolidation. We run above, come back for CAM 1, run for the high, run for the next high. It reverses. There's your reversal setup. Body trades below it. Your CAM model, get out here, because you just see it break right there, and it's run above highs. So there's the reversal pattern. It reverses. Body closes below that candle there. We trade back into it. Now your CAM model people, you're out of this, and you're short again now. Remember we said short here to the one that's set up originally down here? Remember? And this is also a CAM 3 right here. Enter right there. So you get out right there, and you get in short right there. And you run for this low or rejection block, or you're aiming for, remember I told you before about going from the premium one to the discount one? Look at this. Right down into the discount one right there. Are you guys getting excited about that? Does that not excite you? Can I get a hell yeah? Hell yeah!
I'm excited.
For sure.
It's pretty cool, hey?
I have a question for you.
Yeah, sure.
if you don't mind.
No.
On the 4 a.m. 1 minute candle,
Four-
straight down from where you're at there,
Yeah.
there's a wick.
Yeah.
Does that matter?
Does the wick
You
matter
go-
for what? The run on liquidity, you mean?
The 4 a.m. reversal pattern.
Right
That one
here.
right there.
Yeah.
Yeah, does that little wick matter, or does it have to be an empty fair value gap?
Does the wick matter? This wick right here, you mean?
Go over one more candle.
Right there?
To the right. I'm sorry. That one over to the left.
That one?
One more.
This one?
One more. That one. That top wick. Does that matter?
Yeah, no, it has to be a body. The body has to break through this in order to validate this turn. Because you can get these little wicks come up. If the body doesn't break through it, this is just my belief that if the body doesn't break through it, a lot of times you'll just see it roll over and keep coming back down. You're going to see this many times where it comes up. The wick will go into it. Wick will come all the way up here, come all the way back down, and then just continue on the downside. You've got to have a body. For me, you have to have a body. Same as these ones that have these little runs above the breaker. I want to see a body break that, not just a wick, because a wick is a stop run, right? But when the body breaks above it, that has more intentions of going higher. If it's a wick, a stop run, those are your turtle soups you catch for shorts, and those are the ones you look for around 10 o'clock. If they take it, this was a 9 o'clock in the morning, and the 10 o'clock comes up, takes out London's high, Asia's high, runs those with a quick wick, and then gets down below them again, then treats that as a breaker. You get underneath it, or you get the reversal pattern that happens underneath that. You can get short on, or your silver bullet. You're looking for at that point for a return back into the range that was just created between London and Asia. So watch the wicks. Wicks are usually just a stop run for me. When the bodies get above it, there's a higher likelihood that we're going to go higher off of that. Does that help? So when you're looking for this guy right here, this
Yeah,
wick,
for sure.
you want to make sure you get the body.
Got it. Okay, thank you.
I'll try and find an example of this wick failing to give you your run. Like we'll get a low. If I find one, I'll point it out to you just to show you how it's not as reliable as a big bolt. And the bigger the bolder the candle, like, 'cause sometimes you'll just see a little tiny body get above that, and you go, is that really above? And then you start blowing up your charts, trying to make it as big as you can. You're trying to justify, did that really take out that low, or is this just created another equal low? Am I going to turn around and take me out again? I notice when it consolidates, it's not as reliable as a big swing like this, a sharp island reversal where you have a fair value gap on one side and a fair value gap on the other side. Like there's one here, one here. When you see that old island reversal pattern, clean, sharp like that, there are much sharper, better setups than having these things happen in these consolidations. I found that I've got caught on these a lot of times, and I'll show you in Bitcoin how I got caught out on one of these this morning. I saw the setup and I thought I'd take it, but it was right inside this messy consolidation where we just barely cleared out an old high. We're back in, then it turned around and took back off, and I was like, we're in a CAM model. I totally read that wrong. But anyway, I'll show you those a little bit later. So does that answer your question, hopefully?
Yep, sure does. Thank you.
Okay, you're welcome. So here's an example of one you don't get a chance to catch. We did run below a low. Here's another one you don't get a chance to catch. You run an old low. It popped up right there, a body. You say to yourself, is that body above there or is it not? I don't know. It's like sitting right on it. Darren says it has to be like a big body, but is that, guys, do I consider that big? Is that large to me? Another way to look at it is look for the second one. A lot of times you'll see if the first one doesn't get hit and you get a big body come up, look for the second fair value gap. If it hits that one and it still hasn't taken out the high yet, that may be your long. But remember, your stop loss still has to go way down here, so your leverage has got to be according to 1% of your account. So you got to be willing to say, oh, what if it does come all the way back down there again? And then we do the fail-safe model. If you guys like the fail-safe model and it works for you, your fail-safe would have to be like, as soon as a body closes below this, then that is an automatic loss. You got to either scale that out, take it out right there and take a loss on it, so that you don't get your full stop taken. And in this case, it wouldn't be a much more different. But if it starts to roll back up and it comes near you, get out and wait for a new setup. even if it looks like it's going to run all the back. Just get yourself back out, wait for a new setup, because they happen all the time. You're not missing out on anything. And that's the hard part, to get your psychology past. Especially when you see the candle, you go, oh, maybe I'll change my mind. Then you're like saying, I'm convincing myself that the plan that I had and the rules that I had don't matter. And you're finding reasons to break your rules. And you can't. You must find reasons to reinforce your rules, not break them. Otherwise, you're just going back into that gambling mentality again. Here's the swing. A high. You see the body get below it. Come back inside it. Go short. Aiming for that low. Rejection block. You don't get that rejection block, but you do get this last down close candle. You get the body of the down close candle. So look at the range you're in. You say, that's the range I'm in. I got in here. I'm happy with that low if I can take it, or the rejection block, or even that order block, or even that imbalance. I'm good with that, and I'll move to the sidelines and wait for a new setup. I'll just wait for a whole new setup to happen. Here's an example of one that doesn't work. You see how we've got this small little consolidation happening in here now, and that high's not got run out, but this one here has got run out. And you see how the body, here's the swing, but it doesn't go below a low. So if you're trying to use this swing point as you're saying, oh, now I've traded above it, I can get long on that. Good, you better be aiming for this, because if you're not, it just came back against you and took you out. It did not take out this low. So if you look for this pattern all the time and you don't have a low taken out, and it finally comes back and then takes it out and gives you the pattern, you go, why did I get taken out here? Well, because it did not swing the low, and the high is really close. So there's your confirmation candle that you've traded above that area. This is the tap on. Technically, that's rejection block is where you should be getting your first tail trade out, and there. Because if you're aiming multiple PDRAs away from you, you don't get it here. Right? So you always got to think about the little range you're in. How am I going to scale out my profits? Or quickly, if it moves to that level, for example, if you decided to get in on this, and the moment it broke that high, you went straight to break even, and you're aiming for higher. So if it comes back against you, it's okay, I just broke even, didn't cost me anything, I'll get to reset and wait for the next setup. I'm constantly moving that in tight, protect my investment in case I'm wrong. I'm in a consolidation, this may not work out. Get your butt in there, hold it tight, pull up real quick to protect you. Because if you're wrong, you just wait for the next cool setup. Swing pattern. Here, your body breaks below it right there. You trade back up into it, right? Almost hit it there, right here, and you've run through it. Now here's where you have to decide, do I put my entry in here or do I put my entry in here? Here's where the fail-safe saves you guys. If this, let's say this is the pattern we thought was going to go low, and I like this because this is going to be one of those really, really cool, obvious ways that the fail-safe works really well to protect you. Okay, so let's say you were like, all right, Darren, I'm full into your little idea of these swing patterns. I'm going to take the swing pattern. So you have to ask yourself, where do I position my sticks? I'm going to put some sticks in here, and you guys will get an idea of what I mean by moving the goal line. This is like a football analogy for all you American people. Sorry, football for us Brits and the rest of the world. Football is totally something different. But anyway, remove the yard markers here. So if you're looking at putting my trade in here, all right, and I want to always play conservatively, use Derek's approach. Let's say this is the range here, right? Derek likes to get himself a discount, enter into a discount. He doesn't want to buy a premium and sell it at a higher premium unless he's really certain that that's a breaker he can get support off of. But he likes to go for a nice discount, right? So look at this range here. I'm going to really try to break this down really smooth for you guys. We'll go right inside that range there. I'll blow it up a little bit. Here's the fair value gap. Where's the premium and where's the discount of that range? So here's 50% right here of that range. Discount is down at anything, that whole fair value gap is in the discount portion. So you're going to say to yourself, if this runs out the top of this, let me remove this so it makes it a little clear. if I'm going to enter in on this, if I'm wrong and this ends up continuing, because, you know, let's look at the trend here. Don't ignore the trend that you're in here. You're in a bullish trend. So now you're about to counter trend this for a quick run down to run for some liquidity below you, or you're running for this fair value gap. What PDRA are you aiming for? And always remember, if you don't get the PDRA you're looking for, you overshot, because I tell you there's one here, there's one there, there's one there, and it goes through all three of them before it turns around and trades back against you. So you've got to be real quick and nimble. If we're in a bullish market and you're trying to counter trend it, chances are you're going to get your butt handed to you if you're not 100%. So here's a safe way of trading this. Okay, so you're going to put your stick. This is going to be my entry stick right here, and this is going to be my stop loss. And I'll put my stop loss in something different, just because we like it. I'll make it, I think it's red. I'm going to gamble on red here. Is this red? Is there one that tells me the color? That looks maybe red. I'm going to go with that. Anyway, I'm red-green deficient. I have trouble with light pinks and greens and reds. Anyway, so there's where my stop loss is going to be. So I'm aiming for down, right? So that's the typical setup for my trade. And I know that I'm going to put my trade in here versus here. If you're one of those layered people and you like to layer your 1%, so you're going to say, if it comes back and tags this, I'm in 1 or 0.3, 0.3, 0.3, so that'll give me 1% of my account up there. It'll be a little bit more because these are further away, but you get my point. And as soon as it trades in there, the conservative one of you may just say, look, I want to put one trade in here, that's it. I'm going to risk 1% right there. Here's how you save your 1% if you're wrong. You put your trade in right there at the top of the fair value gap, because you know that your fail-safe is going to be this. If we now have a body that trades below, that confirms this is a setup for a short, and we're aiming for either rejection block. You may say, it's not worth my run here, but I do like these down here. I'm in a larger range. I'm in a premium. That's a premium, that's a discount. That'd be an awesome place to aim for. So let's say we are trying to go down here as my take profit. You enter on this candle here. It comes back. So you say, oh, I've already taken the lows. So ideally, do you take the trade if a swing has been taken out? You don't. But let's say you did anyway, because you still want to aim for down here. It comes back in, and the first guy who layered in here, you're in. Second layer lady who's put hers in there, she's in. And whoever else has put their trade on right there. Derek's put his trade on. We'll say Derek, because I love that Derek. He loves a nice good discount, and I totally agree. So he comes into this one here, and he's in. Then all of a sudden it goes boop and closes above the fair value gap. What do we say when it closes above the fair value gap? We say, oops, we're on the wrong side of the market. Right there is the indication, and you don't have to believe me just because it's in the charts. And go back, test this, tune in. If you're new, tune in to us in the morning. We will show you that we'll go, nope, that's going long now, because it's just tip to tat there. This inversion has now been broken to the upside. There's your indication that we're going to go long. So this trade here, now here's where you're going to go. You're going to say, as soon as it either breaks that high, I'm closing my trade off before it hits my stop loss. So that's really how much my stop loss I'm going to lose. Or if it opens like this and goes burp, burp, and then comes back down and hits your original entry, you get out there. Now you're break even. You've saved your short trade to go long. You had the indication that that low was taken out. A big bold candle rips right through your setup. You go, oops, I'm on the wrong side. Now it's either going to rip through and take my stop loss. That's the risk you take. Or it's going to go back down and tag the fair value gap like it does, the inversion, and then it's going to go higher. Well, when it tags the fair value gap, it's tagging my entry so I can get out at break even. Does that make sense to you guys? Give me a thumbs up, yes, if you agree or disagree. But that is the cleanest way I can protect your money with a stop loss that is up here. That is in case it rips, this candle just goes tearing right through you and you weren't expecting it. But if you're expecting it, you should see this break above that opportunity to get out because you just saw you're on the wrong side of it right here. It's going to come back. You hope it comes back to you. If it doesn't, if it breaks the top of it, you're out. You get out right there. That's my rule anyway. So what do you guys think of that idea? Does it work for you? Lewis, welcome. Lobo Del Cash, welcome, welcome. Hell yeah. Oh yeah, yes. Okay, good. So this is how you can be in the wrong side of the position trying to trade a counter trend trade and still get yourself out at break even and say, I'm okay. No stress. That's my 1%. I didn't even lose my 1%. I got broke even. Now I can get back on the other side. So you could literally do this. Here's what will really kind of blow your mind. If I say, if you're really sharp, you're on, watch this. Watch this. This should impress you. You're going to say 2. Now, I'm not saying you're going to be savvy enough, because don't forget we have a lot of emotion involved in this. I am going to put 2 handles short over here. I'm going short 2 handles. Let's see here. We're shorting, not shitting, shorting, sorry, shorting 2 handles. She's getting 2 handles. Shorting 2 handles. Okay. So we're shorting 2 handles right here. Okay. And the moment it pops up here, like that, you drop in, you go, ooh, that's just running up above me. It's closed. Now, as soon as that opens, you can now turn this and go, now I want to change this. You'll go over here and you'll do this. You'll go buy, and you'll put a buy order in here for 4. So the moment it comes down and tags you, it trips those 2 out and puts 2 long from there. So you catch it, and but this is trusting your arrays, obviously. Trust in the fact that you think that's going to run up above here, here, and go higher. It's easy to say that now because I can see it in hindsight. But if you say, you know what, I'm on the wrong side of that, that's my indicator I'm on the wrong side, I'm going to go 2 long there. Because if I'm wrong, where's the fail-safe again? So I'm going to go 2 long there. My stop loss is going to go down here. This time I'm on the opposite side because this 2 short has been taken out, replaced with 2 longs. So you put 4 longs in there. It'll automatically trip those out to 2, break even, 2 extra will go long there. Your stop loss will go down here. If this trades down here, a body goes through this, comes back to it, you're going short again. So then you get your stop loss out. You've taken 2, 1 break even and 1 small loss from there to there. You see what I'm saying? So if you're really quick and you see that's broke above, you just go, oh, slam 4 in there. That'll get me long because this is long right now. You got to trust it. You got to see it enough times to see that it works. And if you get into consolidations, you'll see that you'll go, you're right, you're wrong, you're right, you're wrong, you're right. It just keeps running back and forth over these inversions. And don't forget to check the range you're in. If you're in here and it rolls over and gets back in here, you're about to start a consolidation. So move to the sidelines and wait. Move into your cam model setup because now you're consolidating and then you're just waiting for a breakout. Either a manipulation down below to clean out the lows, run above, creating a cam 1, a cam 2, and a cam 3 entry for further longs. And again, always looking for our reversal pattern, so on and so forth. So there's multiple things you're going to see. There's a lot more complexity to trading than just hitting those little simple turn points. And having a fail-safe, you've got to be really, really committed to and committed to the rules. Because if you're not, and you keep giving yourself, oh, well, you know, I could let that go. There's a fair value gap sitting there. There's a mean threshold of a breaker now because this is the last down close candle before I run below this little low. Well, we've already ran the low. Do you really want to use that now? Get out. Chances are you're not going to come back and revisit it, or if it does, it's just going to go breaker to this order block and then back up again. Again, you'll have lots of things that will start to talk you in and out of trades. That's a whole new psychological thing we can discuss some other time. But hopefully you understand a little bit about that fail-safe now. I wanted to make that really clear on how you wait for your perfect setup, wait for price to come back to you, get out if you're wrong, and then watch. Because if you're right and this mean threshold gets taken now, that becomes a breaker, right? Watch. Mean threshold is taken out right here on this candle. And you go, ooh, okay, we're back into rejection block. Does that roll over and come back down to our, our discount now? Sorry, I just have to clear my throat. Unfortunately, you people are on Skype get to hear me clear my throat. Those people on YouTube, I'm trying to not hack and cough in your ear, so I apologize for that. So here's your mean threshold. It's broken to the upside. We don't have a body breaking that yet. I want to see a body break the high. So this breaker isn't in place for me as a support level until I get a body that breaks above it right here. Body breaks above it. Look at this. Trade back into it right there. Now you can go long there with your stop loss here. There's your fair value gap. If it breaks below it, comes back to it, you're on the wrong side. It's probably going to come back down again, right? There's your fair value gap. Tapping into it, tapping into it. Multiple times you tap into it. You have one more time to tap into it there before it finally leaves. And it's easy for me to point it out, but when you're in the show, you'll see it every minute. We look for these things, and your eyes are going to be darting all over the place looking for your setups. But once you understand clean price action, you'll see those make sense. And you're constantly taking your little tools here and you're dragging them out. Make yourself a whole bunch of these things. So when you grab your box, you right-click it, go to your templates, build a whole ton of colors in your templates so that you can just click it and it's automatically in a color. Do you know what hour that's on? If you're on a 1 minute chart, you'll see that this is an hourly fair value gap above us that we're in. Sorry, I'm gonna get some water here in a sec. So you'll see that the colors represent a specific time frame. For me, my colors are, each one of these represents a time frame, like daily, weekly, monthly. The monthly's red for me. Daily is blue. Weekly is gray. And this would be a 4 hour, 1 hour, 15 minute, and everything. I leave everything at 15 minute from that point. And then the various colors, this would be like a 15-minute fair value gap. This would be a price imbalance. This would be a inversion. It's a little darker, so it's been worked. I know that fair value gap's been worked a bunch of times, so it's a little darker. So I have each one of these layers have their own specific meaning for me, so that when I see the color up there, I know based on my template here that I've built, it tells me what, if that's a reclaimed fair value gap or whether it's a inversion and what time frame it's on, just because I can see the density of the color. Now, so unfortunately, when it overlaps color over color, it can kind of throw you off a little bit. That's why I like to have things like a reminder that says breaker, and I stick that right out to the side so it reminds me that the color is also said right there. You could all leave it one color if you want and just say what's the word, but then you got to make sure the word's sitting close enough, because sometimes it's off screen and whatever. Build your templates. So it's really quick and easy, so you can mark up your charts really fast if you need them. Okay. Anyway, this went into a teaching thing. I didn't want it. We were just doing a market review, so I apologize for going down a side road there. Yeah, let's get back into. Hopefully that helps, and that market review was a little helpful for you guys, and I didn't go too far down the rabbit hole. I tend to do that. Oh, look at that. Way to go, Lori. That was still in there. Look at this. Look at the daily here. This is the S&P 500. I'm just looking for one of those awesome little setups. We have a swing. No, we don't have a swing there. We do have a little imbalance. I do like those little imbalances for places to reach for. Back into old high, running out. Lows, back into an imbalance here. That's a reprice rebalance. Acts like a breaker. Come back inside it. Tag it. Fill it. One more time. Break to the upside. We have an inversion. We don't actually get below a low. That would be a cool one of those cool little inversions where you could get here, you can get on top of it, come back inside it, stop loss goes down here, and you aim for higher prices. But there wasn't a swing in here. This would be one of those reversal ones. This is interesting. So now you see this right here. Let's say we thought that was the reversal. And we're on a daily candle here. So I showed you on the 1 minute candle. So this is to imagine the kind of patience you would have to have on a daily chart. Now, if you're one of those committed long-term swing traders, you're one of those position traders that like to do mega trades, that kind of stuff. Same kind of principle. Here's our reversal swing, right? So there's your fair value gap between here and here. We've run these old highs out. This is making new highs all the time. So you're like, oh, okay, here's our reversal pattern. It actually had a closed candle below the level we were looking for, right? So now we're saying, great. Now the moment it enters back into that, I'm going to go short. So you go in here and you wait for the Derrick entry, which is the perfect entry right here. You don't get it on that day. You wish you would have got on that day, and then it opens. You go, I should have taken that one. No, you got people that like to take one here, and one here, or 3 different levels. They want to take that. But if you want to do the Derrick entry, which is say, I want to protect this case I'm wrong, because the market looks really bullish. So I'm trying to counter trend a bullish market. I'm trying to catch the high. This is where Michael says you can't predict the highs. Well, he's right. You can't predict the highs, but you can save your bacon if you're wrong, right? Most of the time, you're going to be able to save your bacon. So you come in, it trips you in, and then the day closes above you. Your stop loss is sitting right here. And you go, uh-oh, I'm on the wrong side. Now, do you just bail out on that day? Or do you go, oof, the moment it, see, you'd have to get out there, because the moment it tripped above your high, you'd have to get out there. Or you say, I'm going to wait. Here's your entry. It goes do, comes back, closes you out. It didn't take your stop loss, comes back, trips you out, and you sit on the sidelines and you wait for a new entry. Now the decision is, how do you finesse this piece here? Do you say, look, I'm so close to my stop loss now, I'll just let it take it. If I'm wrong, I'll let it take it. If not, I'm going to see if I can get back into break even again. If it just trades back into that fair value gap, which is now inversion to go long, it comes into it here and takes you out, and then all of a sudden you see it close back here the next day and you go, oh, I'm on the other side of it now. Well, the moment it comes back into this side here again, I'm going to get short. I'm going to wait for it to come right back to me one more time. It comes back, it doesn't get you in, and leaves, and you go, oh, I was wrong. And then all of a sudden it goes, oh, maybe I wasn't. Then it gets back on the other side of it again. So here's one of those situations where we have a consolidation where it goes, you're on the downside, oh, now you're on the upside, oh, now you're on the downside, oh, now you're on the upside. That's the problem with consolidations. But here's how you get yourself out. So that one still saved you. Your stop loss still wasn't taken. And if that was a 1 minute candle, you could still get yourself out right here. How you adjust you modify your rules here. If you're underwater a whole day from here to here, that may be a sizable amount there, right? But if you're only risking 1% leverage, like you would on a 1 minute candle, then you're saying, that's okay, I'm only going to risk 1%. If it comes back into my trade, now that we've broken that high, I'll get out there, or I'll just let it take my stop loss and just move to the sidelines and wait for a new setup. And then if the same thing happens again and you say, I want to do a Derrick's entry saves you there because it didn't trip you in. But here, and you got back in there again to go short, you'd be great. Now what am I aiming for? The swing rejection block. Get out there. You've made some money. So you made back what you lost. If you would have lost anything there, you would have made it back there. Because you're just quick, because you're inside a consolidation, so you have to trade inside the consolidation. So aim for your rejection blocks inside consolidation. We'll have to do one of those Sunday. I'll do a Sunday review for you guys on trading consolidations, being inside, and what's the best way to be inside them, and out knowing how to look at your range, looking for your PDRAs, using your fib tools, aiming for rejection blocks, not big low highs and lows all the time. Just aim for the rejection block. Here's a great example. Once again, rejection blocks hit, the highs are not taken. You come all the way back down to the order block before you finally run up and take the highs. So what am I saying about this thing? Sorry, see, I told you I get sidetracked real quick and easy here. What do you see here, folks? Tell me what you see there. Of the last 4 days, people who actually can speak on the Skype channel, if you're on here having a Skype, tell me, what do you see? And those people who are on the YouTube channel, what do you guys see? What's the first thing you see in your mind right now? Or on the chart in the last 4 days, 5 days?
There's a breaker, right?
There's a what?
A breaker?
Where's your breaker? Tell me, what date am I looking for a breaker?
The fourth one, the last
1, 2, 3, 4. This one?
bullish.
Yeah.
Yeah.
Now that becomes a breaker, Victor, when we see a run below an old low. So this last up close candle before a run below an old low. Do we have that low taken out yet?
Oh, no.
No.
Got
So,
you.
yeah, so that's not a breaker yet, but I like the way you're thinking. It could turn into a breaker. But what is inside that breaker that should be piquing your interest right now based on what we were doing this morning?
A possible
I see if-
inversion?
Yes. Yes, we definitely have an inversion now, right? Because this is closed on Friday. We have a wick through, so these are just this is just a reclaiming this fair value gap. We've come inside. We've traded below that fair value gap right there, right? So this is where you guys start getting excited. You start to say, where does my bias for the week happen? You can start getting excited about what your bias is now, you guys, because now you can start saying, if this is true, well, this is an inversion now. So inversion, it's a little darker. See, now it's an inversion. What did we say about inversions? We said we're going to counter trend an inversion. Where's a nice little place for this to come back to? What's sitting down here? What range are we in? Premium. What's a nice little discount array? What kind of lows have we got? What little swing points? What kind of rejection swing points, rejection blocks have we got that can give us a pay on money here? So what do you want to see happen on, instead of me telling you, what do you want to see here? What do you want to see happen on Monday or Tuesday? What do you guys want to see?
Push back up into that.
Yeah. That's the right idea. You got it. So now you want to see this. You don't want to see this low taken out because that's the low. You want to see this open, maybe a little boop, a little pop, make an equal low. I don't care. I'd rather see an equal low. I don't want to see the rejection block get hit. I want to see a little tap down. If you do see the rejection block get hit, look for the swing point on the 1 minute chart to catch a run back up into. On a 1 minute chart, you've hauled ass for the day. That is big bucks all the way back for a 1 day candle. This is like a 1 minute chart. We're on the 1 day here, folks, and we're doing the same reading on a daily chart. So these are the kind of things you go, ooh, I like this. I like to see this big close candle because as soon as we see a run back into here, I'm getting short off of that on a daily basis. So I'm looking for my setup in here, or Derek's setup, which is nice and high, because if I'm on the wrong side of it, I can see really quick on a 4 hour chart or a 1 hour chart that I'm on the wrong side of that, and I can get out before that high gets hit or my stop loss gets hit. Here, I want to catch the swing point. My stop loss will go below this guy here and catch a run back up into that, then start running for these lows. So my bias for the week is a return into this fair value gap above us, and or a run below these lows. So I can pick both sides of it because I know what my setup is looking like. I've already got my setup already formed. I'm waiting for the entry. So I can either trade the reversal back into my entry to catch my entry to go short, so I can go both directions, or I can just wait to see what happens here. Do the lows get taken out? If these lows get taken out on the next candle down, do I trust this reversal pattern? Remember what I said, if you start taking out the lows before you get a chance to get in, you wait. Because if it starts driving all the way down hard, then we start to look for the reversal back up into a run into this area. So you're comparing, you're doing the low, the swing low, trading up to the swing high. Or the swing for the low, and then the swing for the high. Remember we were talking about that. Go back through the video, you'll hear me mention from the one that gives you a reversal this way to the one that gives you the reversal that way, and you're trading in between those ranges. Okay. Cam model people, your cam model 1, you ran above it, you came back into it here, you're running for the high, you take out the high, you create this little fair value gap, you see this, you go, whoa, I'm out. As soon as it comes back in there, I'm getting out of that. You get out, now you've collected all your profits to the first high, and then you come back in and get out right in that fair value gap there, and you wait. And you say, oh, I kept going up. Oh, well, I don't care. I got a couple of days where I had some awesome trades, right? And I never lost my money when my stop loss was sitting down here. Even when that whipped down there and you said, I'm still going to hold that. I took a piece off here and I wait. I'm just going to leave that where it is. You still made profits. And again, that's what's your resilience to a squeeze. I can't say that for you. It's up to you. My rule is if the 50% of the fair value gap, 50% of the consolidation is traded below on a close, you get out before your stop loss is taken. And then you use the same kind of fail-safe rule. 50%. If the next candle opens up and trades back to your 50% to get you out, get out there. Because that's a CAM 2 model entry. So if you're like a Derek, you'd say, I wait for a discount. I'm going to do only CAM 2 models. If I get a CAM 2, if it trades below me, comes back to me, I'll break out and I'll wait for another CAM model entry setup. Same kind of principle. There's a lot of ways to protect your money, folks. And it's having a game plan that works, that's solid on the back end as well as it is on the front end, and as well as it is on protecting your principal. You must protect your principal. And so far, that's the best way I can think of. If you guys got better ways to do it, please, please, please share it. I would love to hear it. So my bias for S&P 500 is I'd like to see our return back into this level to get short into here and into that April's low. I want to see that rejection or that seasonal tendency for April to set the low and then the run back up into May, taking out the highs. So I'm looking for this to be my April rundown into here or here. I don't care. Even down here would be delicious if we could get down that low. But that's quite a lot of points for S&P 500. But here's your opportunity on the daily to catch that tiger by the tail. If you're right, if you're wrong, you're not going to take a full loss unless it just opens up and goes snap right through you. Then that's the risk you take with a stop loss, and that's why you put it 1% there. But you'll get way more leverage if you wait till here to have a stop loss there than getting in here and hope it continues on. You'll have way less leverage there with 1%. Does that make sense to you guys? I'm gonna check. I want to check in with you. It's so good. Okay, good. I just want to make sure I keep checking in with you guys that it makes sense. If I lose you, please, please, please type a letter on the side there. Let me know that you're catching it. If you're not catching it, just write the question and I'll answer it for you. But that's as clear as I can make that. So, yam. I always call it yam. I don't know why it's not Dow to me. It's just yam. See this inversion or this fair value gap here? Look at that. Body's just respecting it. Inside. So that was the fear on Thursday, Friday that we're just going to stay inside this. You wanted to see a body break above it, get some support, and go long. But it just kept rolling back. We're sitting inside this consolidation. So if you're trading this consolidation, what makes this really difficult to trade in terms of the fact that you're inside a fair value gap, and if you're inside this range that's created here, the low and the high, this is the candle, the down close candle that you have to look for on the downside. And this is the up close candle you're looking for inside that range. You see that right there? And look at them. They are overlapping. So there's no place to trade in between them. You're literally going, break this guy, validate that. So you break him, what do? You come back up and you tap him. Then where you go? You go right inside this guy here. So as soon as you break through the mean threshold of that candle, you start to go, oh, there's more downside. So you literally go up, you hit it, and you rip all the way through it. Now we've closed below that mean threshold. Right? So now you're looking for a rejection block again. A retap. It's been tapped multiple times. So now do you have much faith that this is going to hold? Nope. I look for this to get taken out, that to get taken out, and then down into this rejection block here. Looking for reversal pattern. Here's your reversal. We have some swing points here. That's the reversal. Body traits above it right here. We come back into it. Boom! Right there. Stop losses here. And you go, as soon as you clear out that high, move up to break even. Take that high, move up to the previous ones. Again, this is another strategy. So you enter in here. Let me get my sticks out. Let me get some sticks here. Let me show you what I mean. Where's our little pattern here? Where's our setup? Oh, it was right there. Okay. Here's our sticks. Okay, so here's entry 1, and our stop loss is down here. You're doing the Derek. You want the cheaper discount. You want to definitely let the price come to you. So you can either go in here, midpoint, or here, low. Or you can do all three of them because you don't want to miss on the run for this high or the rejection block. So you say, and it's not a lot, so you think, if I'm entering in here, my stop loss is way down there. Is it really worth it for me to go for a run up there? Hell no. No, definitely not. But is it worth it for you to go from here to there? If your stop loss is here, you may go, no, that's still not even, that's barely a 1-to-1 ratio. Not worth my trade. Then don't take it. That's entirely up to you to do. I'm just trying to show you you got to have faith on your setups, right? As soon as you start taking that swing out, there's the body that trades above it right here. We come all the way back down into Derek's long. And now Derek's super happy because he's like, as soon as it breaks that candle's high again, I am slamming this sucker right up to break even. I'm not going to give that a chance to come back to me because it tells me that as soon as I break the high, especially if there's a full body close, then I'm expecting that to continue to the upside because that's my rule. That tells me that I've got more upside. It broke that to the upside, so that tells me I've got more upside. It's come back to me, inside, validate. As soon as it breaks that high again, I'm like, slam up, protect yourself. Now you can do whatever the hell it likes. And the moment it takes its first one, you can scale out a piece there. Now your 1-to-1 ratio is like super snug. You only risk for a very short time. You take a piece off here at 1, you take another piece off there 2, and then you wait for the reversal to happen. You just keep trading that all the way up, moving your stop loss to the next inversion as your fail-safe. If it comes down to you, pops through, comes back up, you get out there. So your fail-safe and your entries are absolutely the same thing. So what is your entry here is your fail-safe up there if you trade, is your fail-safe if you trade through it and come back to it, because then you know you're on the other side of the market's changing directions on you again. So let's look for that. So you run all the way back up, you come all the way back down into breaker, right there. You start running back up to rejection block. Look at that. You just get your rejection block. Well, that's why you pay yourself at rejection blocks. If you take that breaker, pay yourself here. Don't always get your high. So you got it right there. And you're like, oh man, then it's slide. And then you're moving your stop loss up. So this stop loss here now, the moment you've gone from here, sorry, let me make sure this is clear, just so you understand. Stop loss was down here. We got in here, right? The first time it breaks that high, you move this guy up to here. Now you're still in some profits. You look for your first profit taking right there. So you take profits out here, and now you move your stop loss to the bottom of that inversion, because you don't want it to come back to the inversion now. It's already come back to it. Once it's already gone through it. You want to see it take off now. So as it gets through there, you scale out a piece there, you scale out a piece there. And the moment you scale out a piece there, you move to here. And the moment you scale out a piece there, you move to here. And then you wait. And if it goes back up and it breaks another old high back there or a breaker back there, which in this case it's not because it's making new highs all the time, you wait. And as soon as you see it starting to get back here and you've got a swing point, that swing point is created, you start to say to yourself, there's the range I'm in. What's sitting in here that could come back and take me out? Am I sitting in the middle of that range? Yeah. Well, the moment, if it opens and it just taps below this, because I want to see it continue to the upside and I want this to stay open. If it continues to the upside after tapping that, I'm great. So as soon as it closes there, you go, now I'm expecting to see this take off. And the moment it starts to leave, goes to here, and then turns around and comes back down again, you go, I don't want to see it tap that. If it does, I'm out. That's my rule. I'm out, because now it's coming back deeper into this fair value gap, perhaps the mean threshold, or perhaps a complete fill. So that's slamming up, and then you're protecting yourself. So it would sit like right there. When that candle closes and I go, okay, that's the new low. We've run that. I don't want to see it take that low anymore. I want to see it take off from here. And lots of times you'll see this happen. It'd be like a bull flag that sets up a little cluster of consolidation here, and then it finally goes back up, hits it again, and leaves, and get your cam 1 and 2 entries. So your cam 2 entry should not go below that. Or that'll be your new low of your consolidation. That's all you're willing to let that consolidation come to, because you don't want to see it. You've already come back to, you could be saying it could come back to this breaker, and I'm already way up here, so I don't want it to come back to the breaker. Otherwise, it's a lot of profits, because it starts to eat through it, and then I find out I'm wrong. I've lost all this profit. I want to snap up my profits as quick as I can. Again, you may have a completely different trading style, but you're always watching the formation of these candles ahead of you and say, what could be forming in here? What could support my price that I can keep all this profit here and it doesn't come back? Well, there's that breaker there. Damn, that would eat up a lot of my profits right now if it came back to that. You know what? I'm not prepared for it to do that. If it does, I'm okay. I'm out there. I'll get back into the damn breaker if I want. And then when it gets back up to the rejection block, I'll take off more. So you could say, okay, I got out. Good. It did come back to the breaker like I expected. Good. Now, as soon as it hits the top of the breaker, I'm in, or the high, or maybe the mean threshold, whatever you want, whatever your entry is. Or you may go, no, I want it to come back and fulfill. Well, if it fulfills, then it's not as strong a upside trend. You want to see something have a breakaway gap in here, right? And there's your gap. So it comes back into that breaker. You get long there again and decide, all right, I'm getting out of my rejection block. I tell you people over and over and over again till I'm blue in the face, pay yourself at rejection blocks, because you pay here and all of a sudden it comes back against you and you go, ah, crap, it blew through my breaker, I'm out. And I could have paid myself right there again. All that you paid, you got out there, all that you paid, and you didn't take any losses. Again, you've got to really be watching what's going on. It's easy for me to say because I got all these candles in front of me, right? I hear the people out there saying, you're full of shit, man. You're cherry picking trades. I'm just trying to show you logical levels of understanding the PD arrays. And if you say to yourself, if you've sucked your stop loss up really tight in behind this, and you say, what's my range? What's the thing that's most likely to come back to now that I've broke this old high? Well, back to a breaker. Am I above that breaker? Yeah, well then I want to make sure I'm hugging that sucker. As soon as that fair value gap forms, I'm hugging that tight. If it comes back and tags me out, I'm all right with that. I'm expecting it to come back here, so I'm going to take my profits out right there. Instead of looking for these old highs, I'm going to take it out right there because I'm expecting this. Anyway, so where are we at? We are in our setup for a reversal to take out these lows. So we're looking for Monday, Tuesday, or Monday, Tuesday, Wednesday high reversal, or Monday, Tuesday with Wednesday low of the week, taking out all these guys. So Monday up into a run up into here, either here or here or here, wherever you guys decide you want to put that. Stop loss is going to go up there. I suggest the direct discount, reach all the way up into here, or right there. You see that? I do like this piece right here. It's a little imbalance, and it might give you just the thing it's looking for and not actually even give you that high anymore. Just come back into here. So I go 1 and 2, and then they put the stop loss up here, even though it's like should be up there. I wouldn't want to see it revisit that old high. I want to see it just get back in here. And if it does revisit to here, you don't want to see it break that anyway, because if it breaks to the upside, comes back down on top of it, you get out. Take your losses in here. I want to see it come back to that, though. We'll see how that goes this week. Keep your eyes on that price. I'm going to put it in there just in case. Just to say we put it there, and that's my logic for what it's worth. That's going to drive me crazy because it's not perfect.
If you hold down your shift key,
Yep. Shift key.
while you're stretching it out, it'll straighten it.
Ooh. Excellent. I usually just go, I have to straighten it out. Then I hit my shift key and I could drag it long. Oh, I could just do that straight off the bat. Thank you for that. Who said that?
It's Dave.
Hey, Dave. Thank you, buddy. I appreciate that. That's awesome. So look for, this will be the little, golden ticket. Oh, it's an inversion now. Sorry. Okay. So look for a retracement back into this area for the reversal. And again, remember 1% of your accounts up here, whatever you like to trade is up there. And don't worry, your stop loss should not get hit unless that just rips through you, which doesn't look like it does many days like that. You should see a close above this on a daily, come back down and get you out at a break even if it decides to go higher. So far you've seen multiple times this setup. It is now making itself present. This is not cherry picking. You have low hanging fruit setup right here. Now whether or not you trust it, and now your psychology kicks in after you enter this, that'll be the fun part. That's the part you need to journal. What am I saying to myself now? Am I talking myself out of this trade? Because 2 days later, when you look back and go, God dang, why did I not just leave that damn thing alone? Go back in your journal and say, well, you were saying to yourself, you idiot, what are you doing? That doesn't work for that. Somebody else convinced me. Somebody else told me that the fundamentals are changing. The markets are crashing. It's this. I listened to all this other stuff and didn't trust the algorithmic setup. Again, I could be totally wrong, but at least you've got now a fail-safe that will help protect you if you're trading on a daily candle. You'll find that there's a lot of easy places to get out here on the lower time frames to save that before you even even gets anywhere near that. Just so you know. So there you have the Yami, and now Dixie. What do we have for Dixie? What do you see in this range here, folks? What do you see? Tell me what you see on the daily, and give me the candle that supports that.
Well, we have looks like a reversal.
Yes. Where do you see the reversal, my friend?
Well, you got the purple candle on the left, and you had the bullish candle on the right all the way.
This one and this one?
I mean, that one, yes.
Say no,
And
Darren.
then
I want to go over
over-
further.
I do, that one right
There
there.
you go. That's the one I knew you were looking for. I was
looking
just
at.
playing a smart ass. Yeah, so we came
Yeah.
back into this breaker here, right? Or sorry, this gap right here. See how that the gap got tapped, filled with a quick wick down? It's not done there as far as I'm concerned, but it's definitely it's come into that gap. So when we're aiming for downside, here's your setup. You'll watch this. Body trades below it right there. Boop. Next day, boop, pops in, and then you run down into here. You're aiming for here and here and here. Look, you guys, if you saw this setting up and you're a Forex trader, listen carefully, my Forex friends. If you were trading, if this was just popped down below this, this would be the most ideal place for you to see that return, reprice, rebalance, all the way back up into a price imbalance to get short. If you guys see this, my Forex friends, and you say, if this comes in here, and I know I'm not trading the US dollar, but it does give me an idea that we have a reversal pattern happening. Well, when this is reversing, what's it doing for all the other foreign currencies? They're going up. So if you see this reversal pattern, you start saying to yourself, over the next few weeks or the next few days, I'm anticipating breaker, fair value gap, range, premium, discount. I'm expecting a run back to this breaker. CAM model people are saying, I'm expecting a CAM 1 model entry for a run back up into my breaker now. The moment I break that low, it becomes a breaker, breaker to breaker trading, CAM model to CAM model, whatever way you want to look at it, CAM 2 to a CAM 1 model, CAM 2, whatever you want to do. Here to here, you're just trading that distance in between there. So when you guys see this, you Forex guys should be going like, oh man, I'm going long on my other accounts. All my GBP, all the ones that are paired against the US dollar, I'm anticipating this break. Back in February, we said, holy cow, look at that. We now have a reversal pattern for a short. And that short could last quite a long time because below me, I see a fair value gap, lots of equal lows. Below me, I see a big consolidation, CAM 2 model entry, which would be way down here. So I'm looking for there's 104.27. Into the middle of CAM 2 is 103.27. So there's at least 100 pips right there. This old low and this gap sitting down here. And look at that, another CAM model right below you, right into a CAM model 2. Right in the middle of that range, boom, hit it, and then we went racing away from it. So CAM models, this could be your setups, guys. This could be your ideal setup for a long. It could be your ideal setup for a long. And here you didn't get it because that is so close to that. There's not much left of it to really trade into. Comes back inside. So if you're wrong, you look for the fair value gap, and I say, let's say you were saying, all right, I'm going to say this is my CAM model. I'm going to show you how you can save your own butt on your CAM models using this fail-safe method that I'm going to show you here. Where's my... Let's say... you did this as your consolidation right there, that whole big thing. And the moment it broke and came back to it right here, and you went, oh man, I'm going to go long. And it goes, okay, well then I'll do a CAM 2 model. I'm going to go long, right? I'm going to go right at that inversion there, or that imbalance. I want to wait for it to get in there. Now I'm going to, oh, wait a second. We have a body traded below this. Burr, burr, burr. Your little alarm should be going off. I'm on the wrong side of this. If I trade below 50% of that range right here, I'm on the wrong side. I'm out. So my CAM 2 model, I wouldn't. The moment you see it coming back into this range, get yourself out there. And the loss you took was from there to there versus all the way down to here. So your fail-safe saved you from even inside that fair value gap. Even if you came up into that and said, I'm getting out. I got out there versus there. So your hit for your entry in here, your stop loss difference between there and all the way down here. So always have your fail safe. That's why I say to you guys, watch the market, and when you watch it and it's changing up on you, you'll see when it changes direction. You go, damn, I was expecting this to go, I was staying in line with the market. I thought that was going to go higher. And when you see a reprice rebalance like this, there should be a fear factor coming in, whipping up and come back down. That's usually an indication that we're going to keep going back down. Look that up in the ICT index, reprice, rebalance, and how he defines what that means and how that potentially influences where price is going to move to. Make a note of that, put it on the sideline. Thomas, make sure you make a good clean note about that and look that up on that. I think it's more advanced stuff, this reprice, rebalance, and to understand it a little more cleaner. But for those of you who are just starting out, look for these inversions. That inversion right there, we broke it to the upside, right? So tomorrow, if we come back down into it, and then you start to react off of it, don't forget we got high. We want to do a Derrick entry here, which is right down here, which is inside that consolidation again. Your stop loss is going to sit right down in here. You shouldn't see that rip all the way through that breaker now. You don't want to have it down here and then it come ripping through this and say, well, now I should wait a second. Your breakers just got eaten through. So here's where you can modify where you put your stop loss. That fair value gap there lines up with pretty close to the top or the open of that breaker. Down close candle before a run above a swing point. Right, not a super strong breaker. I usually like to see a breaker clear out a significant high, not just these little wicky highs. I want to see body highs. If it ran that out, I'd go, yeah, that's a tasty breaker. That's a beefy. I would go with a bigger, beefier candle, but either way, that's the definition of a breaker. If it runs out a high, it's a breaker. Right, so now we've got this reversal happening. We've come back up inside here. So what are you expecting? I'm expecting this to come back down into here, here, or all the way back down into here. And if you eat through the mean threshold of that candle, or 50% of the consolidation, you get out. You're wrong. You're on the wrong side. If the body trades below this on the other side and comes back into it, you get out, because now all of a sudden we're running for these lows. This was just a retrace back into the next price leg down, which is what we're looking for down here. So if this price leg here to here ends up going from here, let's draw the price leg just so you see. So as you see, I'm arguing both sides of the market here, right? So this is Darren's way of talking himself out of a trade. And what does it come back to? Right off that order block there, that breaker. See how it hit the breaker right on the money? Right there. Right off of it. Beautiful. That will be the next price leg if that's the high. So look for this to pay you dividends. So what would you be aiming for? So let's look at how you look at a setup. Not that you're actually trading the US dollar, but the more you understand the US dollar, the better you'll understand all of your Forex pairs, exotics, right? If you start getting into the real exotics like US or no US dollars, they're all got euro versus or the GBP versus the beast. You know, you go cable versus the beast, you know, Japanese yen. Advanced Forex trading, which is looking for the stronger of the two. And then you have to go to the US pair and the US pair. Which one is the strongest one against the US pair? Then you look at the Japanese yen against other currencies and the British pound against other currencies and see which one's the strongest. Then if you're pairing up pound against the pound, the cable against the beast setup, I'm bullish with this particular currency. Or if you're bullish with that currency, then you switch over to the Japanese yen versus the British pound and look for this setup. You can literally go through all of your charts, all of your time frames, look for this setup. If you're bored and you just want to get trading, look for this setup on all your time frames in your favorite charts. And when you see it, Derrick entry in the discount range. Use your fail-safe. If you're wrong, you're wrong. If you should be breaking even before your stop loss gets taken. If you're right, you're going to start scale out, scale out, scale out, scale out, scale out for quick snipes. And if this is a daily chart, you're making bank. Now compare those on your British pound. So now I'm looking for a return into here, get a level of support. So either support here, or support here, which would also be filling in this fair value gap here. 1, 2, 3. So you have overlapping PD rays. 1, 2, 3, and 1, 2, 3. Then another one here and another one here. That's your line in the sand. If you trade below that on a close, 50%, you're probably on the wrong side of it. It's going to run for these lows here. In all likelihood, it's going to run for those lows. It may not. Turn around, rejection block again, and then start booking it back up. Then you wait for your next setup. If it takes that low, you wait for this setup again to occur over here to go long. Because this will be the short. If this turns into a bold candle going down, so this is what you need to look at. Right now, we're looking for this to go long, right? But this could also, see this little swing point? This could also turn into the short right here, right here. That's why I say if you get a body closing below this, we get a wick into that, I'm all right. But if we get a body close below this, we have a reversal, a continuation on the downside, right there. Even though you're aiming for this to fill in, you go, okay, I don't mind a wick getting down here to fill that. I don't want a body getting down here to fill, because now all of a sudden that creates my rule for getting out of a trade, because now I've got an inversion. See how they overlap? One goes high, one goes low, so you can argue both sides of this. Should you take this trade? Clearly, we're not in the American dollar, so we wouldn't. But we look for the quick opportunity now to catch something on our Forex pairs. So let's go over to our Forex. Anybody have any questions about that setup happening right now on the American dollar? And can you see the logic behind the one that's going long and the potential for one going short? How it acts in here, this now becomes a very important fair value gap now, doesn't it? Because as we open up tomorrow or later on in the next hour and 15 minutes, when this opens up and all these markets start opening up now, when this fair value gap gets tapped again and we start to climb higher, you may miss the opportunity to go higher. What order blocks do you want to just reach for? If they reach for them first and then come back down to them, do you want to take them? Do they hit the rejection block? And then it comes back down and take them, and then rolls through you. And you go, why is it doing that? Well, it's already hit the objective, the premium array that it was looking for. You want it to stay down in this discount array, so then it can run for a premium array, so you can get out. So think about the range that you're in and where we're sitting right now. And how does that affect? Once you understand how that affects, because now we're above, you want to see it just dip down into a discount. What would be an awesome place? Right there. Or touch this old high here, just coming into that level. And you go, great, now I'm going to go short on all my Forex pairs. The moment it touches that, I'm going to go short. I'm going to look for swing points that validate a short. So if you see this on your Forex pairs now, we go to our Forex pair, we look for a short. Look at that right there. Body breaks down below it. You come back up. If we just come back up and tap inside there, there's your short. Strange how that takes out an old high, creates our swing point, takes up that body, breaks it right there. And then the moment we can come back into it, go short, short, or wait for Derrick's entry right here. Because if you're on the wrong side, you can get back out at a break even. If you don't, if you're in here, that's the stop loss you're going to take instead of all the way up there. And if you can actually get it dipping further into it, then you're even more blessed. And then watch. See how this swing point right here? How many people saw it already? Do you see it? Where's the contradiction? I think I just gave it away. Where's the contradiction? Mateus is like, it's stopped. It's buffering. Where you guys can still hear me okay on there?
Yeah, I can hear it. I think it's Skype.
Okay. So do you see this right here? This is the reversal, right? See how the body breaks below it? But you see this fair value gap here and see this swing point? Now we've got below it. So now if we trade a body above that and get back on top of it, here's your swing inside the swing that is already going low. So if you got one that supports low and one that supports high, and we're still expecting the American dollar, if it does run up into this little piece right here, one more time, that will be just enough to push the British pound down. So we'll start getting down into this order block here, breaker right here on that range. So that's where we're going to scale out our first little piece right in here, right? That fair value gap there coincides with this little piece of fair value gap up here, left to trade into. So if you've got reversals over the top, so you think if it comes back into that, I'm awesome, I'm great with that. Or it can even wick up into here, I'm okay with that. I just don't want to see the day close above that line right there. If it does, I got to get out of my trades, because this could be running for rejection blocks. This could be the next price leg up. That's why you've got to be so quick to watch. On a daily chart, you've got all day to worry about it. But on a 1 minute candle, I'd be looking for, is this the next price leg up? Or is this the opportunity to get short and aim for this breaker, rejection block, and obviously these equal lows? And if the American dollar continues to plummet, then we're looking for that rejection block up top, high, and then you just trail it up. When you're breaking new highs, you trail your stop loss up behind the fair value gaps. And the moment the fair value gap is broken to the downside, that's your rule to get out. So whatever you're trailing, you're making a new high. As soon as it trails below that fair value gap, you're going to see a fair value, come back, tap them, keep tapping them, and keep climbing, and you just trail your stop loss up to my next fail point, my next fail point. Because if it fails here, it's going to come back down. So that's how you manage the back end as well as your fail safes. Not how you have to, just an idea. So you see how we've come back into breaker, run above it, come back into breaker. What do we say about that? Does it give us a level of support to go higher? Yeah. We down to rejection block right here. So here's one of those really quick snipes. You catch in, you get out inside this order block breaker right here. I'd get out right on that fair value gap there. A couple of days, catch some nice little raise down there in the British pound. And then you might get the next big run up. Because you're already digging into this breaker already. One more run here, go down. If it breaks above that, goes up, then you're looking for the next price leg up. Watch there. So this is the linchpin for a long, and this is the linchpin for a short. So watch those carefully, people who are into British pound. So, what do you want to see here? What's happening right here? Give me, what do you guys see here? I won't give you the answer right away, or at least the answer that I see, but what do you guys see right there? And does this support the idea that we've just been talking about with the Dixie? So when you're making these notes, you write the notes down about Dixie, the levels you're expecting Dixie to turn on, and then the levels you're expecting your British pound. You see how you're kind of building a narrative? You're building a trade plan that supports a logical level, and you're expecting to see a setup at this point. It changes how you guys feel about the charts. You'll start to feel better because you know what you're looking for. This is what you're anticipating happening. And when you anticipate it and you see it starting to form candle by candle, your level of confidence will just skyrocket. You'll start to feel really good about how you look at charts, how your setups are anticipated. And if they don't manifest, you get excited about that. You say, good, what am I missing? I missed that stupid reversal turn there. This one supports it in this direction, this one supports it in that direction. So, I should be on the sidelines waiting for a clean setup to happen in the direction I want it to go. So hopefully you're kind of seeing that a little clearer and clearer each time we get together here, how the charts are not as random and you're just hoping that looks like a pretty good one there. Well, no, now you can start to say, I want that spot. And I want that precision now. I don't want it just a random area, and I'm going to really put my stop loss down 20 to 30 pips and hope it never comes down to me. No. Now you'll have saying it shouldn't come down to here. If it does, I'm out before it even comes down there because it's breaking my rule. Your trading will become so much more comfortable. You'll become so much more confident about your entries when you have a plan, start to finish, and then you're fail-safe in place, and then moving yourself. If you're worried quickly, you can move yourself into profits. As soon as you see a certain point break where your next fail-safe moves to, you go, now I can move myself to break even. I have a zero stress trade. And it doesn't matter if it trades against me, I'm okay. Because I'm just practicing my entries, my setups, and I can get long. Sorry, I'm lecturing you guys. I don't want to lecture you. What do you see here? This whole area here. Who have I got on my Skype here? Victor and David. What do you guys see?
Yeah, I kind of see the same thing. You have a little bit of a reversal setup there, but I could see where it could go either way. It was a lot like GBP.
Right, exactly, right? You see this little tiny spot right here? Did we get a body below that yet? Hell yeah, we did. But now we closed and we have another fair value gap here. And what do we trade below? A swing point. So you can see how you go, I've got a body below there. If it comes back up and taps that, it's a short. But if it actually closes above this level and comes back into it, that's a long. Right? Because I've swung below a low. I've come back up onto it. Now I'm going to look for higher prices. Rejection block, old highs, and equal highs up here. Now, am I expecting the American dollar to go down? What was our bias? Our bias was, well, we're expecting it to come down, to go back up, or if it blows through this one, we're expecting it to continue going down underneath that, come back up, find some support, and continue pushing through for lower prices. So here we can see either direction. So you got to wait for Monday and say, now where does Monday's candle, if I plop a Monday's candle in here, does that give me a cleaner idea? Like if you see Monday's candle goes wick, taps that thing there, and you see it close up above, is that a good sign? Hell yeah, that feels like a much better run for liquidity above the market here or higher, that order block. If it trades below, it really digs down and we close into this here and it closes in there, you go, okay, I'll wait till Tuesday now. Does Tuesday give me my close here? Does Tuesday tap this, wick down in here, and then start to snap off of it? Then I go, great. If that just taps off that and I see a really clean, hard wick off of that, and I close above that level there, then I say, now Wednesday, as soon as it taps that high again, I'm going long. And I'm going short on all my other guys here. So then I'd be looking for this to go short. That all I'm going to do is run back up into that order block, tap it, and then roll over and come back down because it's now a breaker. Come up in there. Now I get short and I'm starting to aim for this breaker here. Breaker to breaker trade. CAD.
So that's what ICT talks about a lot, right? With just you need more data at certain times.
Exactly. That's why you wait. He likes to wait for a Monday and say, what do I see on, what do I expect for, I can't give you an honest appraisal until I see what happens on Monday. So that would be an example of, well, we don't know what's going to happen. We've just argued both directions. So if you can argue both directions, what does Michael say? Stay out of the damn charts until you see something that has low-hanging fruit. So Monday, pop a Monday candle in there. Does it give you a clean setup? If on Monday it's sitting there and waffling around in the middle still, you go, I still got nothing, guys. Sorry. We'll see what Tuesday's New York Open is. We're waiting to see what London creates for us. Then he'll look for that and say, now, can I get in something? You know what? I'm waiting for the afternoon session. And he literally breaks it down into into afternoon, morning sessions before he sees something a little more clearer that says, okay, now you've tipped your hat. Now you tell me, now I know where you're going. Does that make sense?
High probability versus low probability, right?
Exactly. Low-hanging fruit, my friend. That's exactly what you're looking for. So we've got...
The thing, Karen, sorry.
Yep, go ahead.
The thing for me now is that in terms of futures trading, of course, it makes all sense to just wait, since we have both sides probability. But what took me on the charts now was that trading the stocks in which I have a portfolio.
Yep.
So some of my positions are already in profit.
Right.
So I need to make a decision. If I close those positions in a little bit above break even, or either with a bit of profit, and wait flat to see what happens on the DXY and therefore on the indices and the market stocks,
right?
Or, which I think it's the way to go for me now, or keep waiting for the DXY, and if that takes my stocks portfolio into a bit of loss, of course, close the positions with just a little loss and wait for a new setup.
Right.
So it's interesting for me that sometimes, like in futures, it's quite easy to wait because we have no positions, right?
Right.
But in the stocks portfolio, we do have a stocks position, so we need to make a decision in terms of should I wait or just close break even or with a bit of profit and wait for the next setup. That's it.
Yeah, I'm going to show you because I've got up here, I've got a whole bunch of stocks that I have, and I'm going to share my ideas of stocks as well with you guys. Exactly, I totally get what you're saying. I've got Tesla lined up here, and I don't buy Tesla. I buy an ETF that pays 30% dividends on Tesla. It pays 30% dividends. So I'm waiting for this to get down into a premium or discount price that's going to increase the dividends huge for me. And if I can catch 1 month's worth of profit and I get an extra 2% on a dividend payment on top of a principal investment, I move to the sidelines. I've made like 10% on the stock plus 2% on the dividend. I've got 12%. Now, my philosophy is that if I make 12% on my money, if I just can make 10% on my money every single year, I'll have millions and millions I can leave the kids at the end. Because there's a program that you guys need to get a hold of that will manage. Unfortunately, it's only for Canadians. So, but it'll give you a good idea if you've got a LIRA, if you've got a RSP, TFSAs. So Workout Warrior, he's out in Ontario. You get a program like this, you program in everything. It tells you your taxes. It tells everything that you're going to pay. It even tells you how much to take out of your RSPs when you convert them into RIFs and so on and so forth. And you can literally say, well, if I expect to make 10%, it'll tell you what your pension is from the government, how much you're going to get, how much you can live off of every month. And then you just adjust. If I can average 10% per year on my portfolio, I could live off of $100,000, $200,000 and never worry about going down. I'll always end up giving my kids a ton of money at the end of my death, if that's what you want to do. So my objective is 10%. If I make 10%, I've bought myself time. Now, coming into an election year, I want to get my 10% on my entire portfolio out as quick as I can, and then have low return, low risk returns on the rest of my money, all moving in cash. You stick it in a cash account that pays you 4.5%, whatever, RBF 2010 if you're Canadian. You can put it in there, make 4.5%. You've already made your 12% or 10% for the year. You've now bought yourself time. In other words, I can go the entire year collecting 10% dividends on a stock that's flat, that's not gaining me any principal. If I just live off of dividends, I bought myself a whole year. So I always look at it as I buy myself time. If I get my 10% in for the year, I can move to the sidelines for the rest of the year, collect really safe returns on my money, and next year I aim for another 10%. Throughout that year, I just need to get 10% on my portfolio, and you double down on that. Every year you do 10%, 10%, 10%. Your portfolio is doubling every 3 to 4 years, I think it is.
Wow, that's great.
Yeah, so I'll show you how to do it.
I'm Victor Hancock starting today.
Yeah, I'll show you what and how to look for key setups in stocks. It's ridiculous. It's so much fun. So here's your. I want to get to the stocks right now because I'm so excited for you, Victor. So here's your breaker. Look for this breaker here to come back. Find some support at that. Do we get some support? I want to see that roll over now. If the American dollar does take a dive for us, I want to see it pop up into here. That would be the last of that fair value gap we saw on the Dixie, right in here. That will push that price up on the Canadian dollar, and the Canadian dollars will start to tank a bit more, but come back into a breaker, which is a senior candle inside a fair value gap. Now I don't want to see that climb above this. So this fair value gap here now is what I've got my eye on. That's the one that the Dixie is in right here. Okay, they're overlapping. You can see them. That's the one it's coming up to. So as soon as it hits that, I want to see it kick off of that and start rolling back down, and I want to see it get below this one. As soon as it gets below that, pops into it, and I think great. Now my Cam 2 model, I want to see that get blown through. I want to see 50% of that get taken, and I want to see it run all the way through the lows here. And obviously we want the Canadian dollar to improve, and you'll see this in a minute. Oil will greatly influence Canadian dollar oil, but for some reason we got a lousy government, so we don't have really good management in our government with money. They're just spending all the time, so our dollar's crap. There used to be a day when the American dollar was worth less than the Canadian dollar. It was a powerhouse. Now it's just getting $1.35 it costs for that. It's crazy. All right, let's move on to New Zealand dollar. Well, that totally came down past where we thought it was going to come. Give me a second. I'm just going to grab a drink. I'll be right back. Grab yourselves a drink. Take a little break. I'll be right back. We're having an awesome day here in Canada right now, or in Alberta right now. It's been so sunny. The snow is melting like crazy, and then we're supposed to get just dumped. Like all the snow is almost melting away now. The streets, you can see the streets, the grass is all starting to come through, and then it's just going to be a massive dump, so we'll be up to our knees in snow. Apparently Wednesday, it's just going to, we go from a nice hot day of plus 12, plus 15 degrees, and all the way down to minus weather with huge amount of snow. So that's where Canadians get all grumpy when they see the sun. They come out, then they see their shadows, and then they have to go back into their. So what do we see here? See that rejection block? You don't even get the high taken. Just under the high, inside the rejection block, and you get denied. Anybody who was going for that high and they had their stop loss sitting down here waiting just lost a ton of profits. Always pay yourself, people. Always pay yourself at a rejection block. The difference between those two are so close. They're so minute in terms of the wick size, but the profits you're about to lose if you're wrong because you got greedy and you overshot your PD arrays is painful to see. You get so angry with yourself. You say, I should have paid myself for that damn rejection block again. So many times. Look at this one here. How many times did people think that I was going to finally take that and run into that fair value gap? Rejection, rejection, rejection. All these are rejection block inside that swing point. Just multiple times. And then it just bailed and just tore you out. It's just sad. Pay yourself at rejections. You'll be happy you did. And move to stop. If you're at rejection block, move yourself to break even, whatever you do with your stop loss. Because it can turn on you. Anyway, where are we at? We're inside this. See this little setup here? The swing below this low? Right here. We traded above it right there. And we did not get a chance to get back on it there. And we just left. Aim, bing, bing, fill. Next fair value gap above you. You don't get that one. So we look for reprice, rebalance in here. Body trades below it, you still don't get in on it. Here's a reversal. You trade above it, you come back into it, you tap it, but it can come all the way down into here, right? This is what we're afraid of happening over here, remember? You see this? This is what we're afraid of right here. That's why I like to show you this as an example of that. You see, mind you, this is all, these are two. But if we see, oh yeah, no, there it is right there. So we're looking for the same thing in the American dollar. So as it comes back down and taps this now, you're expecting it to run back up. So if you are, and that is your entry, let's say that is, you take that entry right there and you go, where am I first going to get out? Pay yourself at what? The rejection block. You just saved yourself some money because it's about to hammer against you. Because if you're wrong, and we see a body start to trade above this, then we think we're going to go higher, right? That's your extra support. And here's our inversion. So we've got an inversion to go high, an inversion to go low. So now we have overlapping decisions to go high and an overlapping decision to go low. Do you see that? Somewhere over here, overlapping decision to go high, and what's happening in here? A potential overlapping decision to go low. You see that one there and there is what formed as a perfect example here and here. So this one says, if I trade below that with a body, am I on the wrong side of the market? My stop loss right here, if it gets taken, or sorry, if I'm going to go short, so my stop loss would go up here. So this one, as soon as a body trades below it and it comes back in there, I'm going to get short, stop loss is going to go up there, and you don't even get a chance to get on it. See how the wick went through it? I like bodies. If you're back to your idea, David, that if I use a wick through it, then your wick idea would work great. You'd be in a big haul here. I don't like wicks. I like bodies. Here's an example where it did work for you. Okay. And you've already ripped all the way through this breaker. Mean threshold. You've closed below. What am I anticipating? Further downside prices. So we're anticipating then, just based on this, if this was in conjunction with the American dollar, I'm expecting more upside of the American dollar. That little fill of that fair value gap. Run, then roll over and come back down. It'd be great if you had a little pop down, slam into that, then grab it and run up. I'd be all cool about that. Don't forget, pay yourself there if you are. That's that's your PD array above you. Move yourself, as soon as it does, move yourself to break even. So New Zealand again. So I'm expecting more downside prices on New Zealand dollar. We are in the rejection block, so you may not get the full low taken. It may just turn around here and start coming back up again as the American dollar rolls over and comes back down into our area we're looking for over here. If this rolls over here, this becomes the swing point. This opens here Monday and just starts coming back down and tags this, and then Tuesday comes back down, dips into this one more time, and starts to run back up. We'll see how Monday's candle closes. We'll look at where Monday's wick ends up or its high ends up. The higher the low will help us give a better idea of this area or this area for a run higher or lower. Australian dollar. as it's a little stronger than its cousin, New Zealand dollar. See how New Zealand dollar gave up that fair value gap on the daily? It has not given up its discount fair value gap. Premium, discount. Premium, discount. If you were gonna put these two together as an exotic, let's say you guys are trading Aussie New Zealand dollar, who would you be banking on? Who would be your stronger? Who would be the sixth sister in that group? Shout it out. Who would be the sixth sister? Anyone? If you're trading New Zealand dollar and Australian dollar, which one's the sixth sister? You're using those as your exotics. You're teaming those two up against each other. Who's the sixth sister?
Is it New Zealand?
Yeah, for sure, right? Because we have the premium array is held. We came down. We've actually opened on the bottom half of the inversion. So there's our reversal pattern. We've closed below it now, right? We're expecting this to finally give up the ghost and go back down. So if the American dollar gets a little weaker, then it gets a little stronger and pushes us down. This one here, it's already blown through its discount array. You see that? That first one down below here, which is what we're looking for in Australian dollar. See how that just breaks the premium array? We just have a little open. We closed on that premium array there, and then we closed below it. So we just opened and popped into it and ran back down. We just came into this candle's low here. Look at New Zealand dollar. There's the low. We drove through it. We popped up into what? Nothing. We're not even up there anymore. We just gave up the ghost, and we drove all the way through our discount array below us, and Australian dollar hasn't gone in there yet. So if you're looking for a Australian dollar play, we're right back to the breaker. You want to see that hold price and start to run back up. We find some support off of this, so this just turns into back into the mean threshold or the equilibrium of that range to start driving it higher. You want to see it get back up on top of here. This needs to provide support. If it doesn't, look for a kick off of here, and then look for a reversal pattern like this on the lower time frames to support a run down. Oh, this is a 15-minute candle. This wasn't even a... Oh, yeah, no, it's a daily. Sorry, I was on a different chart. So then you're just looking for a run back into this. If the New Zealand dollar is any indication of what's going to happen to the Australian dollar, then we're going to blow right through our discount array and through our CAM 1, closed below our CAM 2, so you definitely wouldn't be in this one. CAM 2 is getting eaten up. So now if this is a really good example right now. Let's say you went with a CAM 2 model and it's closed now here. And you go, I was going to go CAM 2 long on this, CAM 1 and a CAM 2. And you close today like this, you go, oh yeah, this is a great example. You can say now, oh man, I have to do my fail-safe. If it closes below 50% of this consolidation, I should be out of this trade. So now you look here, your stop loss is sitting here. You look for this to open, trade back to your 50% and get out, break even. So tomorrow, Monday, you're looking for any return back into your high or your open and get out right there. Don't worry about if it goes up. Wait for a new setup later. Just get yourself to the sidelines and wait, because chances are that's going to take these lows out. You want to see just one candle get you back into your get out of jail free card before it takes your stop loss. Does that make sense? So you CAM 1 people, if you were in there on CAM 1 and it's traded way below, ideally you'd love to see it. If it keeps coming back to you, look for your supports on your, so if you're on your daily, you have to use hourly, 15-minute or 5-minute candles to support going back up. And the moment you see a reversal happening on one of those candles, then you say, that's it. That's as high back as it's going to come. It's going to turn around and go back down. I have to cut my losses there. So you can manage your stop loss back to break even by using your lower time frame charts. to get you back to your break even on your daily. That's another strategy, but you have to be really good at doing it on a 1 minute, and you'll be able to use these lower time frames to justify, yeah, we're still going back up. I'm reaching for my stop loss again. My new break even. I just want to try and get back to my break even. Oh, it's reversed on me. I'm out here because now it's reversed. It's going to keep coming back down. So I'm out there. I didn't get all the way back, but I've really cut back my stop loss that way. So it's a way of managing your tail end on a daily chart. If you're trading daily, that's how I would manage it on lower time frame. If I had overshot my entrance and I'm like, I'm definitely on the wrong side here now. Like if this was me here on the daily, I'd be like, my stop loss is here. You can either let it run out, or you say, hell no. As soon as it starts coming back up, I'm going to use my 1 hour chart. Every time I stay above my 1 hour chart, and if I go into the 1 hour chart right here, this is the example I'm looking for. So I'm looking for, if it's going back up, I'll say great, 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 great. And the moment it breaks a inversion right there, you expect it to come back into it, I'm out right there because now I know it's reversing. So I've been trying to manage this stop loss back up until you see the reversal pattern. You say, now I have to take my stop loss off here because that is my new stop loss, because it's now just tilted its hand to me and so told me it's going to go back down. So sure enough, down she goes. Okay, does that make sense? So if you're a long trader, you can use all these principles for long trading and use your lower time frame. That's why you see me on a 1 minute chart every day. People say, why do you only trade on a 1 minute chart? Yeah, because it gives me all the practice I need for whatever time frame I want to go play on. I can use the price action I study on a 1 minute chart, because we'd be bored stiff waiting for the next one. Say, I'll call you back in an hour, you guys. Come back on and we'll look where the next candle comes back. And we only get 8 opportunities for that before we pass out of boredom trading on a 1 hour chart. On a 1 minute chart, you understand price action. Everything you see on the daily, 1 hour, weekly, whatever, all exactly the same stuff. We're looking for the exact same setups. How you manage it is going to be on the lower time frames. It's like saying, I'm on a 1 minute chart and I'm going to manage it on a 1 second chart, which is what our buddy Huddleston likes to do. That's why you see him going, I'm long, I'm short. Or we're going, what? What are you talking about? The 1 minute hasn't changed yet. He says, yeah, but the 1 second has. He knows, right? Anyway, let's move along here. Australia, Japanese yen. Look at that. We wanted this now to be that's the high we were calling for. And look at that, right on the money. So we were calling for this return to here. Now we're looking for this next price leg down for Japanese yen. So if you're trading the beast, that is a dandy potential for another run down. So what we don't want to see is, see how the body broke the high right here? Here's the swing point. See, the body breaks the high right there, and then it goes boop, pops down, gives you an opportunity to get long, and hello. What's a logical place you can reach for? A big old fair value gap daily on just above you. Old lows right here. Beautiful place to get out at. And that was your setup right there for the swing low. Taking out a low. Perfect entry on a daily. And you got 1-2 days of solid up. Enjoying the fruits of your labor. And we called that right on the money. You get out there. Now you set your stop loss. Your next price leg down. So what you're looking for now, again, is just a matter of timing, you guys. Don't say, I'm going to definitely, I've called the high here. I may be wrong. It may go up into here. I don't care. If it continues to go up above this tomorrow or Tuesday, then you go, I just wait for the turn. And then I look up here and go, okay, there's a fair value gap. There's a CAM 1 model there. There's a CAM 2 model here. I'm looking for those places for that turnaround to happen on the 1 hour chart or the 4 hour chart that says, now I'm going short and I'm heading back into this fair value gap, that old order block, this fair value gap, that breaker, or that would be an order block, rejection block, lows. Don't overshoot and come all the way back here or say, I'm aiming for this only. There's a ton of PD arrays that you have to get through that may turn around and have reversals on you and take you out. So anyway, oil. We're getting closer now. Oil. Oh, this is exactly what we called for on Friday. Lovely, lovely. We are looking for a run above these highs finally. And then we wanted a small candle to form in here and a fair value gap to form. There's our fair value gap. Perfect. Monday, we'll watch. See if we get a retracement back into this. And when we look for a breaker, see how this swing point right here, this last up close candle, is this dude right here. You draw that guy out from there to there, all the way out. It's literally inside that guy there. So I would expect to see this trade back down, fill this thing up, come all the way back in, tap that breaker, leave that open, and then continue back up to the upside. So I'm looking for a Monday candle to start coming back into this. If it stops here and bounces off again, I expect to see that one more time, find support off of that, and then continue to the upside. But again, we have to wait for Monday's candle. But I am looking for a retracement back into this range before going too much higher. If that helps. Gold, 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 gold. Look at that. That sure nailed our... I love the fact that we hit silver. See how it's come right back up into that breaker again? Right on the money, it hit the breaker. Like right in the body. You can't tell me that these PD arrays and this algorithm is not running every freaking commodity, stock, everything in the markets are run by the algorithm. The same setups. And we called this sucker right here to here and called it to there. That's like 2.5, 3 weeks worth of positive trades with almost zero drawdown. Well, that would have been zero drawdown. You would have been right on the money there, going all the way up. It happens everywhere, my friends. Everywhere. Gap. Body trades below the gap. Open, back to the gap. Taps the gap, and then starts running for low and fair value gap fill. Last down close candle before run above those highs. If you're looking for the fill there, you didn't get it. You didn't get it till all the way over here. Then we have a run below the lows. See that? Oh no, you didn't run below the lows. You ran below these lows. There's a little tiny... See that little imbalance right there? Body trades above it. Do we get back into it? Stop loss goes here. You got back into it. Right there. Mean threshold gets eaten through. You go, ooh, I'm on the wrong side of this because now the body's traded below it. Right there. You come back up into it. You get out. Right there. Break even. Didn't get your stop loss taken. You got to go break even. Then you wait for a new setup to happen. Right here. Low, high, fair value gap. Body breaks above. You wait for it to trade back into it. Right here. You're in long. Oh my goodness, folks. Looky, looky. All the way up there. And it's that simple little inversion pattern. In silver. Not in futures. Not in Forex. In silver. My friends, in silver. Go through your charts. I kid you not. If you don't believe me, just go through the charts. You'll see it. It's plain as day. And then trust it. And then have your fail-safe. Don't forget your fail-safe because you'll get your ass handed to you if you're wrong. Like in this case, if you didn't get out right there at break even, you got your stop taken right there. You got your stop taken and you're like, that doesn't work. Well, no, that's break even right there. That traded below the body right there. That says, oops, I'm on the wrong side. Get out. Wait. Ooh, good thing I got out. Now I'll wait for a new setup. Oh, look, this one's forming. That took out all those lows. Oh, lovely. When it comes back into here, I'm going to buy that. And I'm going to aim for that high there. I'm going to aim for that high or that rejection block up here. And then I'm going to aim for, oh, look at all that fun up there. Anyway, you get my point. Let's get on to some fun stuff. Royal Bank stocks. Does this happen in Royal Bank stocks, perhaps? We have a swing point. We break above it. Oh, no, didn't get you a chance to get in there. What about an opportunity to go short? Look at this. We break above an old high. Body, oh, wicks. Oh, no. Body finally breaks below. Do you get into it again? Oh no, they denied you and you didn't get a chance to get in. Oh well, your day will come. Here's one right here. Swing below the low. Body gets above it. Oh hells yeah, we can get in on this. Right? Comes back in and you go breaks. There's a setup for reversal. I'm trying to get in long on this one and I go, oops, I just seen this one forming. I don't want to be getting in on this one when this one's telling me it's going short. So back, and you've seen that happen. I'll back up in Dixie, and a couple of times you've seen this example. So when it's right here, you go, whoa, breaks. I'm in a bearish trend. What's the chances of this continuing on the downside versus running against the grain here? Oh, well, I guess I'm just going to have to wait it out and see. So if that one closes below there, you can get out. If you're short right there, you get an opportunity to, or long right there, you get an opportunity to, oh no, sorry, this would be a short here. If you can get short there, you're in the money, you're killing it. But if you're looking for this to go, as soon as you see this one open, below that low, you go, no, I'm already heading back into here. That high hasn't been taken out yet, so maybe it's just coming back to get me long. Do I want to risk having one that says it's going short and one that says it's going long? Like Michael says, which one do you want to be in? Neither. It's easy to say, hey, I would have gone short. Then you're gambling. You're plain and simple gambling. Because now this guy here, you don't even get an opportunity. Oh, you might. Look right here. If you do the Derrick entry, which is right at the bottom, and it ran all the way through, your stop loss is sitting here, it closed here, you go, ooh, man, I'm on the wrong side of that thing. I hope it comes back to me right there, and I can get out right on my break even, and then it finally comes down and takes you out. Or did it open, go down, come back up, and then stop there? I don't know. Your stop may have been taken, or you may have had one little tiny opportunity to get out right there. Let's pick a different stock over here. Here's all the ETFs that are killing it right now. All of these are double-digit ETFs. All of them. They all pay more than 10%. So here's a simple, let's pick a swing point. See this body right here? There's a swing below a low. It comes back into it. You don't get in on this one. This one here, you see that swing below, it broke above. You're not in on that one. It obviously, when it starts gapping up, it says, I ain't sticking around for nothing. I just took out the low. I'm out. Here's a swing point. We swing below. Your body trades above it. You come back into it, right there on the money, and off you go. Okay? Now let's get into a Tesla stock. And I'm going to show you how you do this on a stock. Here's your gap. Swing low. The gap is traded just like any other fair value gap. A gap is traded. So the moment you break above the gap right here, and you trade back to the gap right there with precision, zero drawdown, you just took Tesla from 177 all the way up above here, 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 and then you're just managing the back end, waiting for the reversal to happen. And when you get these gaps violated on the downside, you go, I'm out. When the gaps are violated on the downside, you just get out. Or you wait till they come back to here, you go, okay, it's hit that, load up more, go long. When that gets violated on the downside, or this gets violated on the downside, I'm out. Broke above, you're still in. Now, we have a gap down this time, different story versus a gap up. That might be your reason to get out. Or you just go, all right, I'm out here, because it's now crossed below it. The moment it trades back into it, I'm out. Another one. We have a swing below. If you don't get the first one, look for the second one. Body goes above it right here. You come back into it here. You're going long. Again, look for your PD arrays. inside the range. Do I want just 50%? Do I want to come back to an old gap here? Do I want to just come back to an order block? Do I want to take out a little swing point? I can't tell you guys how to trade your trade, but be careful and don't get greedy and look for ones that it may not pay you out, or at least pull up your stop loss tight behind you if you're not sure which one to reach, and make sure that becomes your safeguard. So if you come up to here and it rips through, comes back, finds some support of that, and starts to move away, you go, now bring my stop loss right up behind that. I do not want it to revisit that. It comes down a couple of times, then finally breaks above. You go, great, that becomes my next support level. If that breaks through that on a down closed candle, I'm out. If it comes back right there, down closed candle, you're out. Comes back, revisits it. Stop loss would be here, and down you go. Here's your swing low, run above, come back into, perfect entry right there to go long. These things happen on stocks, folks. Bitcoin. Welcome to Bitcoin. Crazy. Body trades below it. Come back right up inside it right here. Boom. Running for here, 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 here. All these lows. Reversal pattern right here. Body trades above it right there. Come back inside it right there. Stop loss here. You're scaling out there. Comes back in. You get to play that game again. Comes back up, takes that high out. That high. And then look at all that. Reversal. Do we get the same damn thing on the reversal? There's a reversal. Body comes back up. Hells yeah. Gets short. Bitcoin's beautiful for this right now. It just keeps rolling and rolling. You look for these perfect little setups, and you can collect tons of coin with that. Tons of coin. This is my Bitcoin account so far. It's up to 180,000. And I started this on November 3rd. And I just traded that on the 16th yesterday a bunch of times, and those were all the wins, a couple of losses here and there. I took $1,000, and then there's all these, again, we don't care about the money, but just letting you know that the wins are just like little wins. I'm not trying to get the big home runs. There is a huge home run in here. Like there's $11,000 hit. Like these are all small wins. And this is what I want to do. Just inch it up, inch it up, inch it up. That's the big win. The $55,000 one. And that's where it started, November the 3rd. So, but just try to, you're not going to get these big grand slams all the time, but small little hits is all you need. And you can drive your account up. And I tell you, Bitcoin is, I don't profess to say trade Bitcoin, but right now it's giving you some dandy little setups here. Like, look at that, right to precision. Do you see that? There's the inversion. You trade below it right there, and when you wait for it to come back to it, look at it right there. There's the Derrick entry. Zero drawdown, you're in. And you just cleaned that there alone would be $15,000, $20,000. Mind you, that's with a 40 lot. If you had like a 10 lot, that would be at least $5,000 to $8,000. Easily $8,000. Huge. So, Victor, give me a stock, and I'll look one up here, and let's so let's just do wheat. You can see the same thing in wheat. As soon as the body trades below here, there's the swing point. See it sit. Then all of a sudden the body trades below it. And then look at this. Pop into wheat. And you've bought wheat contracts all the way down. Aiming for this fair value gap fill here. Your wheat was a perfect entry. If you're trading commodities, this works on commodities. Imagine using your options trading. And you knew how to trade this. And you could trade options and saying, I'm going to sell puts. I'm going to sell puts on this for here. I'm going to sell a covered call. So people buy a covered call thinking it's going to go higher, and it just peels down to nothing, and you make the contract cost because it goes down to nothing in a very short period of time. So you make your money, you walk to the sidelines, right? So you could use this for options, stocks. Let's just do, give me a stock you guys want me to look at. Pick
What
one.
about Google? Maybe.
Google?
Yeah.
Google. What's the sticker for Google? Go?
Another O and G. Goog.
G-O...
OG.
O-G. Oh, it's called OG. O...
No. Sorry. Just add. It's G-O-O-G.
G-O-O-G. Oh, Google. Alphabet. Google Technology. Which one are we looking at here?
The one at the top.
This one right here?
Yeah.
All right. So Google. Here's your setup for Google. Looking for your swing point. So if you're buying this stock and you're looking for a swing point, this is why you take your time. You buy yourself time for the year, right? If you're buying, look at this one here. So we have a swing below. When the body gets above, right here, that candle there, you start buying Google. You buy into my range. You buy all the way through here. You buy all of this. And you're running for high. So your dollar value, maybe $1, that's like not very much. It's like 10 cents. Probably not going to do you any good. But if you're making dividends off of that, you're saying I'm buying in a swing point at a low, and I'm going to just let that ride now until I see something in the opposite direction that proves I'm on the wrong side. Here's the swing point. You see, oh, wick, a body closed below it right there. See that? That body closes below here. You go, now I'm out. As soon as that comes back into that, I'm out. Right there. So when I bought it in here to go long, I get out there. It comes back in. I see this kind of setup happening again, and I go, great. As soon as the body gets above that, I'm going to start. You could just start your buying frenzy right there. As soon as that body closes, you say, I'm buying now. Buy, and I'm aiming for the next swing point or until I see a reversal pattern happening. And then I'm going to get out, and I'll wait for the next setup. We get consolidation. There's a little swing right here. Body gets above it right here. Let me make this a little bigger so you can see it. So you don't think I'm form fitting it here. There's the swing point. We've taken out these lows. Swing point. The body breaks above it right here. You start buying. Buy. And then all of a sudden you just go, it takes off. Now you wait for your reversal to start happening. You wait. We have this candle here. It's taken out some old highs here. It's coming back into a very high premium array, a breaker that's a really big senior breaker. It's come right up into that level, right into the mean threshold of that candle. See that right over here? Beautiful. Then you say, ooh, look at this. If this turns into a downside candle, I'm out. And there it is. Boom, downside candle. You sell your stocks right there. You're out. You bought them right here. You sold them right there. Now, obviously, you can't short that unless you've got a margin account. You can short it. You're doing the same things. You're trading this no different than you would a futures account. And now you're looking for another reversal to happen. So we wait for a low to get taken out. This low right here gets taken out. Here's our swing point. Body goes above it. We get into it. You start buying it again, and you're aiming for here, you're aiming for here, and you're aiming for the mean threshold. So you start scaling out your stuff here, and you move your stop loss. If you can move your stop loss on here, stand by. I've got somebody coming in. I'll be right with you. Hello. How you doing? I'm just doing a show, so you can go right to it with your thing.
Yeah.
I'm just chatting. So you can see how that's set up. when you're buying stocks, you're looking for those specific setups that allow you to get in maximum profits and get out real quick. Most people have the mentality when they buy stocks, like here's a beautiful CAM model entry. Look at this big consolidation here. It comes all the way back to a CAM 1 model entry, and you can sell CAM 1 model or buy CAM model entries for Google. And look at that. You just cleared out that old high, right off of a CAM model entry 1. Right? So if you're a CAM model person, you can use that on stocks as well. And you look and you trade it until you take out highs, move your stop loss up behind it if you can manage. I know some accounts may not give you the ability to have a trailing stop loss on your stocks. So you have to be watching them every day. And you're going to say, that's going to be my fail safe now. If it comes back to there, I'm selling my stocks. If it breaks through my low and shows me that that's it, I've now got a reversal pattern happening. Unfortunately, you're giving up a ton of profits here because in order for that to break, we want to see a body get below there, right? So the body gets below here and you go, oh, now this becomes the reversal model. Okay, that becomes the reversal model. So now you gave up all of those profits there if you didn't pay yourself at rejection blocks. You're giving all these profits up to now see the reversal pattern happening right on this candle right here. You see it happen. Then you go, as soon as it comes back into that, I get out. I sell my stocks off there. And then you wait. You wait. We have, if you consider this a swing pattern, let's say you did, and you bought right here. Let's see if we can head off this potential doom and gloom here. We'll put it like right up against here. If we didn't see this happening next, and we're going, oh, look, we have a swing point right here. A body breaks above it. You see that? Body breaks above it right here. I'm going to go long when it gets back to my discount array because I'm going to do it in the Derrick, right? I want a discount array and I want to be able to go long above these old highs here. I just want to take out these highs, rejection block, those highs, and back into that fair value gap. Those are my PD arrays I'm aiming for. Here's my swing point, so I'm going to go off of here. Now my stop loss will go down here, and I'm looking to buy Google to go long. Because we know doom and gloom is coming our way. Let's see if we can't get out of this being on the wrong side. So here's our entry. Let's put some sticks in here. Oh yeah, this is where it just goes shift. Thanks, David. You saved my butt. I don't know how many times I've gone, oh, damn it. Come on, give me the 00. Now David's giving me the old, just go with your shift button. Oh, you've just saved my bacon there, buddy. All right, let's put some sticks in here. Clone. All right. Here's our entry right here. I want to come back in here. So you go entry 1, entry 2. You can layer your buys in if you want. And our stop loss is going to go down here because sometimes you don't always win on your entries, right? Okay, so let's just go one candle at a time. So next candle forms. It comes down and we're almost bought in. We're almost in there. Those of you who are layering in your buys, you're in and in there. That's great. Now you want to go, all right, let's go to our next candle. We're waiting. We're doing this a day at a time here, right? We didn't get in. We didn't get in. And those of you who did get in, you're paying yourself right now, right there, right at the rejection block. We always say pay yourself at the rejection block. So you're only in for a couple of days. You pay yourself here. Move your stop loss right up tight to you now. Remember, if you pay yourself for the first one, move your stop loss up tight. Again, it's easy for me to say, but I already explained this, so it's not like I'm just form-fitting, just knowing that doom and gloom is around the corner here. I'm trying to show you how this works. Your setups and your fail-safes work. It snapped right through you. And literally, this one here that we wanted to get long on, that we didn't get in on, if you take your high, what did I say to you? If the high is already taken, do we enter the trade? No, we don't enter the trade. So you delete your trade. You take your trade off. But let's say you did leave it on. It ran right through. That's the unfortunate thing about where my fail-safe model doesn't save you. You literally have your stop loss taken. Ram. And you're lucky because your stop loss was there. But you saw even in here, as soon as you get your rejection block, you pay yourself. And here's a great example that the high was never taken. You hit it perfectly, and that's it. It did not go above you. So a great example of you just dodged the bullet there. Those who were in here and here, they got in and they got out right there. They paid themselves and moved quickly up to break even. So when it rips down now, they didn't lose anything in this trade. But whoever was going in for the direct discount, you didn't get it. It just can't. And if you held it because you didn't recognize that we broke the one spot we were aiming for already, it just ripped right through you. So there's multiple points where you could have lucked out, made some money, and there's the point right there where if you didn't give your rule, that point right there, then you're screwed. Hopefully you see that. Okay.
Yeah, of course. Thank you.
So that's Google. Give me another stock. Something else, some more obscure stock that's not so big and robust like Google. Give me another one so that you guys can see an idea of one. And anybody who's on the net right now, if you've got one, give me one on the channel there, and I'll show you a lower end one and how the algorithm is on every single stock that you're on. You treat your stocks the same way you treat your future setups, and you'll have the same kind of thing. You could have been in and out of this thing 3-4 times in that. Oh, this is just a 1 minute chart. Holy smokes, I didn't even give you the daily. Sorry, let me give you a daily. Let's go back and do that again. Sorry. That was a 1 minute chart. You're in and out in a 1 minute chart.
But the good thing is that those are fractals, right?
Yeah,
so
exactly. You got it, my friend. You got it. Yes.
Our concepts, well, actually, Michael's concepts, they work at any time frame. So.
Absolutely, they do. Absolutely, they do. Here's the swing point, right? We have a swing below. We gapped right up above it. You go, great. I'm going to trade the gap. My stop loss will go down here. You were a little bit underwater, but then all of a sudden, boom, you run for the highs. You got those. Waiting for a reversal. We have this massive gap down. Inside the gap is where you want to get your entry points, or inside this gap here, because that's the swing point. You get your entries in 1, 2, and 3. You're in. You're aiming for rejection block, lows, fill of the fair value gap, breaker, rejection block, old low. You don't get the old low, but look, we got a rejection block again. That's why you pay yourself at rejection blocks, my friends. Here's our reversal again. Body gets above it right here. We open on the opportunity to get long right there, and we're long. So if you're in Google daily, there was your opportunity when you saw that swing taken out and that gap form. As soon as it trades above your gap, you get back to your gap, you go long on that for running this gap here, the old highs or the rejection block, then that gap, rejection block, and the gap above. Don't forget these spots in here too. They're also very sensitive. I'm going to give you one, something like, let's go with an energy stock. Sorry, go ahead.
Sorry, I have an interesting case, at least for me now, which is PayPal. Right?
PayPal, okay.
PYPL.
PYPL. PayPal.
PayPal on its earnings report a few days ago got very good results, right?
Yep.
So I got a really good entry there.
Excellent.
Now on the daily. So now that it's in a position in which I either take my profits now and re-enter later,
right,
or just let it go down, because I know, or at least my analysis is that it will keep taking higher buy side liquidity, right?
Mm-hmm.
So this is specifically the case I was referring to. So I think the smart way to go for me now, based on that we have both directions on Dixie, maybe I should just take my profits now If it retraces back to another entry, I will get in again, and that's it, right?
Right. So if that's your philosophy, and pay yourself some money on the sidelines, especially if you've caught in at a nice little, like when they made their, this is their earnings. So if you got in on the earnings really well, right off the order block here, you've got a swing point with a gap on it. For me, if you trade above that gap, which you almost do right here, you trade above that gap. If you trade back into that gap and you get long with your stop loss sitting just below here, and you get the Derrick entry right on this low, this really good discount area, you're aiming for 1, 2, 3 scale ins to go long. You've already come back right up to the top of that. So if we get a retracement back into a fair value gap, old low, or old highs here, there's a $2 run right there, just back to that fair value gap, right? So that's less than 1%. No, $6 is 1%. No, 60 cents is 1%. No. Yeah, $6 is, no, $6 is 10%. So 60 cents is 1%. So that's a 2% return just back into here. 2, 3, almost 4% return back into here. And that's a Cam 1 model. Cam 2 model inversion. So I'd like to see that come back into here, then go high, run for these old highs here. But look for your reversal pattern. See how you have the gap up right here? We have a swing below a low, obviously an old low. We've taken them out. We see the swing pattern form right on earnings day, breaks above. Everybody gets excited about earnings day. Wait for the sentiment to drift away, and then look at this. Right back into top of the gap. Right there. Right on the money. Tell me that has anything. You see that?
I think it's time to. Yes, of course. I think it's time to pay the trader now.
Yeah. And don't feel bad.
I've been greedy many times, as you already said, and gave back the profit. So not this time. It's time to pay the trader.
Pay the trader. And you know what? If it takes off on you, just get excited about it. Just say, great. That means, especially if you have big bold candles, you just say, that's fine. Don't get upset about it. Just go, that's cool. Eventually it's got to come back down. It's got to gap down. It's got to show me my next reversal pattern. I know what I'm looking for. When I'm buying stocks now, I know what kind of turning points I want to get in on. Now, if you understand seasonal tendencies and you go, October is the best time to get my seasonal tendency low for stocks, look at this, right into October. Boom, October, the reversal happens. You get in right there, November 8th. Welcome to the rest of the year. Seasonal tendencies. Look at your seasonal tendencies in your charts. They make a huge difference. Look for your May, your April, May runs on liquidity. Look at that. May, boom, right down into the end of May. June and then July. So there's your little banging around in June. July makes a high, August makes a high. Run all the way down into September. That's August low. September high, all the way back into October low. And I don't even know PayPal. I understand, I know what PayPal is, but I couldn't tell you if that's on a financials market or what market, or they're on the NASDAQ. Oh, so that's technicals? That's the tech industry? I thought NASDAQ was all tech stuff. Anyway, it's running according to the seasonal tendencies, right? This guy's remodeling my kitchen, so I'm sorry you're going to hear some banging. But if you trade your stocks the way you trade your futures, you understand the algorithm. It doesn't matter what. You can give me any stock. I don't care what stock you give me, what commodity, what. If it runs on candles and it runs in a major market, I guarantee you it's driven by the algorithm. And you can find these setups that will pay you perfect entries. And you'll go, how the hell did I catch a perfect entry like that? Or your friends will say, how did you do that? You say, I knew exactly where to get in. Right there. Unless you're going for a Derrick entry, which is right there, and you would never have got it. You missed it. But you layer. That's why when you're buying stocks, you have a different philosophy. You layer in your buys with your stop being down here. If that gives way in terms of on the downside, then you know that the stock is going to continue on the downside. You can get out of it and wait until a new setup on the downside so you can buy long again. If you're waiting for October, if you're seeing this, you just go, you know what, in August, I'm going to buy it. If I see a reversal pattern in August, here's the August reversal pattern. Body trades above it right here. You trade right there, just barely gets above it, comes back into it. You go long. You're aiming for here. And then you said, by September, I'm getting out. So I'm in here for 1, 2, 3, 4, 5, 6, 7 days, a whole week and a half of trading. Takes my high. I'm out. I wait now. We have another little high in September. Great. Now I'm expecting it to start running back down. I'm expecting a time of year for prices to reverse into October. Look at this. There's our breakdown below. Do we get a chance to get back in? Nope. Now you go, oh, now we're going. This is great. I'm just going to sit on this now. You sold. You waited. This is all waiting. Yes, you've missed a whole October, dividend payment. Who cares? You're about to make it back in principal and dividend until the end of the year. It's being more strategic on your entries. Know the seasonal tendency of the market you're in, because it runs pretty close, and look for they give you a good indication of what your PD arrays are that you're aiming for in that seasonal time. You don't always trade your seasonal tendency, but if the seasonal tendency says that in August you're expecting to make a high or a low in this chart, and you say, great, I'm coming up here and I'm just coming into the July and I'm making a high, I go, ooh, I got a beautiful cam model sitting in here. This high to the low over here. So I'm going from that high to that low, and I'm going to put my little equilibrium one in there. There's 50%. Now the rule is, are you going to trade? If you close above 50%, you get out of your trade. That's the rule that I use. You may go, you know what? I think I'll give myself some slack in here, Darren. There's still a gap. If it trades up into that gap, as long as I don't trade above this gap here, I'm going short. I'm going to stay short. That may be your buffer factor right there. And you'd be right on tight with your buffer, because there's your gap close right there. Perfect. And you go, oh, good, I'm glad I held in there just a little while longer. And that's your CAM2 model entry on a PayPal account. A CAM model entry, right? It's beautiful.
Which, Darren, that leads me to put on the table another topic, if that makes sense, which
sure.
Might be something like portfolio management. Let me explain myself, please.
Okay.
So, it is my understanding that our, let's say, starting point for analysis might be the Dixie, everything else, like the indices or the markets in terms of stocks, right? Individual stocks.
Yeah.
Maybe if I properly learned from Michael or someone else, even above the Dixie or the US dollar, it's the bonds, right? But that's another topic, I think. What I'm trying to say here is that a few weeks ago, I was thinking on my portfolio management in terms that if I invest with you guys lots of time analyzing and learning about ICT concepts, mostly in my case, particularly for the NASDAQ futures, and then with that time invested already there, I manage my stocks portfolio, for example, for an ETF related to NASDAQ, such like the TQQ, for example. Then most of my analysis on the index, it's quite identical for the ETF. But if like it is my case now, I also invested some time analyzing stocks like Tesla, Google, PayPal, whatever.
Yeah.
Then then I have triple time invested, not only in the Dixie chart, the NQ chart, and now a stock chart. What I'm trying to say is that I'm like open to retrace back from individual stocks and can get only into an ETF like TQQ, so that with a single analysis, I got not only the futures bias, let's say, or strategy, but also for the ETF. It's what I'm trying to say again is like time investing, right?
Oh, absolutely.
Because it's the same. Once we, of course, I'm a beginner learning from you guys, but once we have invested the time in a chart like the NQ, then we will need to invest the same time for PayPal chart, right? Based on the same context. But at the end, you are investing more time.
Yeah, I totally agree. But just know that whatever time we spend on NQ, like you said, it's all fractal. Everything all the time we spend on NQ is exactly the amount of time. And understanding PayPal, it's not that you have to understand PayPal. You just have to understand the algorithm that drives PayPal. And you can buy and sell PayPal just like you would any other asset class by understanding what we do on the 1 minute chart in NASDAQ, understanding the algorithm, reading price charts. When you get down to these 1 days in here, because you obviously can't trade a 1 minute chart on PayPal because it's not enough. It's not really moving. It probably looks like an absolute mess in here. Like a lot of, yeah, look at this. I suppose you could. Yeah, I guess you still could. There's enough volume in there for you to continue to trade that. There's a, you still got like swing points that you could still key off of to get long and short. There's your reversal pattern, body trades below it. You don't get a chance to get in on that one. We have a gap above here. You come back in, you find support on a 1 minute chart. You're aiming for here. If you're in and out in like, you're trading 15 cents at a time, if that's how you like to trade it, it's available to you for sure. If you want to trade something like that, but it's like saying everything that we're doing on the 1 minute chart in the NASDAQ gives you all the clarity you need on any other asset class that you're on. Look for those. Have your setups, whether or not you're a CAM model trader, whether you're a reverse trader, whether you're a 2022 model, whether you're a breaker model trader, whether you're an inversion model trader, whatever. Like I probably have about a dozen trade entries that I like to take, but if you've got 20 different entries, the more versatility you have, with the more models that you have, the better and better you'll get at reading price. And you'll say, well, I don't have my inversion model, but I have a sweet little CAM model here. There's a body breaks up above me right now. Good. If it trades back to my CAM 1 model, I'm taking that long. Look at that. Perfect entry for a CAM model entry for a long. Running above old highs. Right inside that consolidation. Like, wow. If you're a CAM model trader, get really good at it. Develop your biases, your rules. You must have rules for when it fails. If you're a CAM model 1 or a CAM model 2 would put you back into here. Now that's not your entry, of course, but it never comes back into there until it's taken out all your highs. But anyway, get really good at whatever model you're at. Stay with it. Hone that skill like nobody's business, man. And I tell you, it'll pay you massive dividends in the end. It'll pay you massive, and no matter what asset class you're on, it won't matter. Put the time in, 1 minute charts, reading price action till you get so good at looking at the range that you're in and the premium and discount arrays you're constantly running to, and you go, I know where that's going. I know where it's going to come to next. Now it's got to bust out of there because it's getting compressed and it's got to go somewhere else. You'll get to the point where you know that it's got to go somewhere, and it does. You get excited about that because you know what the next setup's going to be. It's going to be a CAM model entry, or, hey man, then we're right near a nice swing point. I'd love to see a little reversal pattern happen right about here so I can get long on that. If you went here and that was your reversal and you go, oh, I didn't get in. Oh, look, I got in. Oh, I got in. Yeah. Now, if it gets below my low, my stop loss, look, it comes right down to you and probably would have taken you out there before finally going up. But you would have seen that the reversal model happened up here. This one you're aiming for, you said, okay, now if it didn't break that low, it broke that low right there. I'm out. So that entry in there, get you out there because you see the reversal model happening. And did you pay yourself at the rejection block? Right? So small little areas, if you aim too high, you wouldn't have got that. But these setups, man, look right there. There's another setup. Body trades above it. This one right here trades back into it perfectly. You need to see this, you guys. This is big. Right here, another PayPal. This is on a 1 minute chart. There's your fair value gap. Body trades above it right here. Came back into it, tap right there. Oh no, maybe it didn't quite come into your... what am I doing? What do I know? Right back to an order block. But yeah, you didn't get in there. Sorry. I thought you got... That was a good entry. But it's back inside the inversion.
It's really mind-blowing how the concept of the fractality on different time frames, it's mind-blowing.
It is.
And the other thing really is, I know we all in this group know about it because we are related to ICT, of course. But the fact that ICT concepts are applied to everything, it's mind-blowing also. So
yeah,
wow.
Yeah, it truly supports that whole idea about algorithmic theory. Like I look at that and I go, there's no way you could tell me fundamentally that was the perfect entry. There's no way you could tell me any boardroom meeting or fundamental charts or some Bollinger Bands would have told you that is the perfect entry. And consistently, we've been seeing that they're perfect entries, like consistent changes at consistent times. Because when you start adding time and price to that, you go, oh man, am I looking for a silver bullet entry here at 10 o'clock now? Like, let's see if there's a silver bullet entry that happens around 10 o'clock. 10 o'clock. There's your 10:07. There's your swing low. That's the swing point right there. There's 10:11. Here's your silver bullet entry. If it comes back to it, boom, silver bullet entry.
Really nice one.
Yeah.
you
right?
happen to find a really nice one.
Yeah, and that's a silver bullet entry, and we just picked that out of PayPal on a 1 minute chart. Does it work? Is it time and price? Is it specific to time and price? Hell yeah. Beautiful silver bullet entry. I wouldn't have taken this one, even though that's the very first one he says to take is the first silver bullet. I'm not liking the silver. Much as I love Michael, I'm not crazy about taking that first one. I always like thinking that the hour creates the wick, and it's the first 15 minutes. I'll be right back as somebody's at my door. I love Michael. I really do, but not 100%. Hello, he's here.
I know, I can see his truck there. We have to go get Sean O'Brien a Shamrock Shake today. They're green.
All right. Sorry about that, boys and girls. Sorry. Yeah. So there's so when you understand time and price, and you're in a stock, can you see how your stress level of buying and selling stocks can become so much more easier now when you understand time, price, specific key levels that you want to key off of? You can be in and out of a stock. Imagine doing this buying your options to go long on this sucker at 10.07. You say, here's a silver bullet. I'm buying that as an option. I'm selling options long. Or I'm selling shorts here. And it goes long. You make all your money because all those people that wanted to go short, they were buying those contracts. You get all that money and then you just close it out. Done. Less than an hour later. Because at 11 o'clock, you're expecting a reversal. I always expect a reversal around 11, 11:15, 11:30. I always expect a reversal back into the range that was created between 9:30 and 11 o'clock. And I expect a 50 to 65% retracement in that time. So I look for a setup. There's your setup right there. Body traces below it. You come back inside it right there. Stop losses here. And you're in short. In PayPal. We're not even in futures, people. Look at that. Perfect setup. Right at 11 o'clock, and we get our setup happen. You just wait. You wait. 11 o'clock, you just, even if you sold out at 11 o'clock and just said, I don't care, I'm going to sit and wait for whatever happens after that. And then you wait for you say, ooh, here's my setup coming. I just want to see a candle get below that. Oh, there it is. Perfect. Now I'll put my buy entries here. My stop loss goes up there, and I short it. And where am I aiming for? I'm aiming for this order block down here because that's the breaker. As soon as I come into that, I start scaling out a piece there. I start scaling out a piece there at the rejection block because you don't get the swing. See that? But do you get the rejection block? Hell yeah, you just tap on the rejection block right there. Boom, boom, boom. Then it finally rolls over and comes back and takes you out.
Yeah, once we have invested the time to analyze let's say the NQ again, and there's no reason not to go with options, which I haven't. Other than with options, we need our own money, I think.
Yeah.
While with prop firms, we don't need our own money. But other than that, we already have a good understanding on where price will go.
Yep.
So there's really no reason not to. I was thinking like, okay, if I can remain focused only on NQ, let's say,
right,
then I can trade futures with the prop firm, ETFs, the related ETF as a stock like, and also the options, either calls or puts, all of them based on the same analysis.
Yep. That's exactly it. This is the best thing about ICT stuff is you can take his tools and go anywhere. You can travel anywhere in the world with it. A laptop, you can trade and buy and sell on the road, and you can buy and sell at specific times. You can wake up in your hotel room and say, let's pay for the hotel room right now. They're gonna pay for this trip. So you just sit in there in your hotel room, trade that, make some cash, make a little bit of extra, tip the busboy, tip the waiter, tip everybody, and all you're doing is just with a laptop reading price action. I know it sounds cocky, but you can get to the point where you really understand it cleanly, and you can make a ton of cash at that. Is it CVE? Yeah, it's CVE. We're just going to do a Canadian stock now. Swing point right here. See that swing taken out? We have a first little fair value gap. We come all the way back into it. Derrick entry, perfect entry. Looking for highs, fills, and rejection block. Done. That's a 1 minute chart, and you're done in 15 minutes. You probably made a couple of grand just inside that. If you're trading it, and you can trade it on here. And who cares about the delay? You have a 20-minute delay? I think it's 20-minute delay. In here, it's 20 minutes can make a big difference, of course. But you buy your data, you can see these things switching up, changing up on you, man, and there's your swing point. We run above a high. There's your reversal. Open up, you're inside it. Tap, tap, tap multiple times. You run for low. There's your rejection block again. You come back up. Let's try it one more time, you said. And then you get it again. So you get to double tap it. start your whole trade over again. Put all that money in your pocket and start your trade all over again. Stop loss here. Do the same thing. Aim for here. Fair value gap fill and rejection block. Look at that, right off the rejection block. Eventually it hits there. But again, range, discount, premium, run right back up into premium again, and then run all the way down and take out the discount rejection block, come back up into premium again, come back down into discount, mean threshold, or sorry, the equilibrium back and forth, finally runs down and takes you out here. Like, you can just see this premium and discount. You can watch the algorithm literally run from premium to discount over and over and over again. And once you understand the range, you'll understand if it's staying up in here, it's staying up in the premium and discount of the premium range. Because Michael talks about that in his charts as well. But that pretty much brings me to the end of that run for the day. I hope you guys enjoyed yourselves. I hope you had some got to do a little bit of learning here, a little bit of fun. Thanks for sharing some ideas with me. I'm sick of it as a dog. Okay, well, let me just read some of these. Hey, homie. Hell yes. Oh yeah. Such good. I love this stuff. So do I, says Thomas. I have so much to learn. We're almost done. Almost done. You said it right, Dave. Look up, reprice, rebalance. I will do. We'll do the same. It's buffering, so stop. Google had to drop. Thank you. Hello. Hello, rule. Follow the rules. Be patient. I'm sick as a dog at the moment. 3 a.m. But damn, I have learned so much, bro. Well, I'm so glad you got to learn something. Sorry you're sick, Lobo. I hope you get a chance to have a little rest tonight. And that's going to be it for me. And I will see you guys bright and early tomorrow morning. Thanks for my couple of guests that popped in on the Skype account. Thanks for Victor and David. Thank you for popping in. It was a pleasure having you guys in there. Oh, I guess David's gone already. It's just you, Victor. You're the only one left. But thanks for popping in. And I will see you guys bright and early on Monday morning. Thanks again. Take care. Talk to you soon.
Gracias.
Gracias, my friend.